we're in the midst of a pretty significant set of shocks.
The elements that normally tip bull markets into bear markets are not present. The biggest challenge, though, is how policy unfolds.
I'm not super bearish on risk assets for the next 6 to 12 months. I think it's a slowdown, not a recession.
We're going to be in this environment where it's heightened uncertainty for equity markets. We think hedging is something that investors should be very focused on.
This is a point-in-time moment, and then we're going to go back to business as usual.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Let's get you to the weekend, and us too. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Friday with stocks attempting to avoid a fifth straight week of losses. Equities inching lower as the president once again makes a push for lower interest rates. He wants Chair Powell to, quote, do the right thing, just as the White House doubles down on additional tariffs.
The president has been very clear about his intention for April 2nd. It's going to be a big day for our country. The president will be highlighting the unfair trade practices, the ways in which America has been ripped off by every country around the world, quite frankly.
So the promise of more tariffs and the hits to corporate America keep coming. FedEx cutting its full-year guidance for a third consecutive quarter, plus Nike offering a long list of complaints, including geopolitical dynamics, volatile foreign exchange rates, and new tariffs. Are they real problems or just a convenient excuse?
Yes. Is that fair to say? I mean, this is what we've been dealing with all throughout earnings season. We've seen companies come out and cite incredible amounts of uncertainty during and then talk about how they're lowering their expectations for this year. With Nike, it's a specific story. It's a turnaround story. FedEx, you could argue, is somewhat of the same, although they did talk specifically about how some of the tariffs, some of the de minimis, some of the packages that are going between companies have come down. That's maybe a little bit more of a bellwether story.
I think what you see is these two companies. You can maybe say it's idiosyncratic if it was just these two companies. But we've had a litany of companies come out and say they are seeing the consumer under pressure. We've seen that from Kohl's, from Dick's Sporting Goods, Nike, talking about the fact that these new tariffs, implementation on them, the imports from China and Mexico, they're now having to take that on board when you look at their bottom line.
Chairman Powell had this to say earlier this week. I would tell people the economy seems to be healthy. Took note of the soft data softening, but pointed to the hard data that hasn't. And that's where we're at right now, somewhere stuck in the middle trying to figure this out.
Which is the reason why every single central bank is just saying, we're kind of on hold, we're kind of in a cloud here, we're not going to continue. I would link the two stories or the three stories, I would say, of the economy and the lack of certainty in central banks, companies coming out with forecasts that reflect that uncertainty, and the president saying the Fed should lower rates. Because what it addresses to me is that all of these companies are citing higher inflation. We heard that from FedEx as well. Inflationary pressures that are really crimping their bottom lines, but also are causing them to pass along costs. How much is President Trump trying to get out front of some of those concerns and say, well, if rates are lower, that can offset this, and then everything's fine, and we're going to expect weakness, but we can get through. How much is it girding for what's to come?
We need to get you an update on the airlines as well, so let's talk about that too. So this morning, IAG, Lufthansa, Air France trading a little bit softer throughout the session over in Europe. The latest from Heathrow, the following: closed all day due to a power outage caused by a fire at a nearby electrical substation. This is going to cause disruption for days.
This is the biggest disruption for Heathrow in more than 20 years. I was looking at some of the statistics for how many flights, 1,400 flights and 200,000 passengers every day through Heathrow. What a nightmare. Why do they only depend on one substation for energy? I don't understand.
It is a very good question. Why do they not have other energy ports coming through into the Heathrow? This is the main hub of basically the center of the world. If you want to go through Asia, potentially you stop through Heathrow. If you want to go to the Middle East, you're stopping through Heathrow. So a disruption not just for one day is an issue, but if this is going to be days, it's going to cause a tremendous amount of havoc.
Think how long it takes to figure this out. Never mind the planes in the sky that were due to land at Heathrow. You're now going to have planes, jets, crews, all in the wrong places for days. So there's other flights that were linked to these flights that aren't going to happen. This is going to take a long time to figure out.
Think about all the connections. This is the main hub if you're flying to so many different places in Europe, in Asia, in the U.S. Think about where they get rerouted to. There was one airport that said, well, we've taken 7 flights. 7 flights? I mean, this is thousands of flights that are getting rerouted. It's going to be a mess. Let's see how quickly they can resolve it.
This came from Heathrow, a statement from the airport earlier on this morning. Over the coming days, passengers should not travel to the airport under any circumstances. We'll get the latest from Guy Johnson on the ground over at London Heathrow later on this hour. Coming up this hour, we'll catch up with Jack Caffrey of JP Morgan Asset Management, with stocks looking to snap a 4-week losing streak. Bloomberg's Alex Morgan will join us too as London's Heathrow Airport shuts down, and Nouriel Roubini of NYU calling for a North American economic union. We begin this hour with stocks lower. Jack Caffrey of JP Morgan Asset Management writing, within equities, it is interesting that no sectors are screening as either overbought or oversold. The weakness in stocks tied to consumer spending is eye-catching. Jack joins us now for more. Jack, good morning. Good to see you.
Pleasure to be here.
Let's get to the earnings. Just how bad is Q1 going to be for some of these companies?
I think we probably need to rename earnings season guidance season, because for the most part, companies do a very good job of trying to manage what they think they can deliver over the next 90 days, and then, surprise, they beat it. The question, though, becomes, well, what can you do for me next quarter? What can you do for me the rest of the year? And I think that's where the whole concept of uncertainty really comes to roost. Managing a portfolio, I wind up making decisions that involve moving considerable amounts of money, but I can change my mind and reallocate that capital. If you're trying to make an investment decision around building a plant, where should I build it? And I mean now, what country should I build it in? Can I get labor? Can I get power? What will my cost of imports be? It becomes really easy to decide, I'm going to punt and make that decision later when I get clarity. I think when we go back to the Fed statement, I think the most cited word was probably uncertainty, uncertainty, uncertainty. And so it's not really helping people try to understand how they should think, what policies they should embrace, or how policy changes affects those investment decisions.
The price of the story matters, and expectations have shifted. Clearly, when you speak to economists, they've dropped their forecast for GDP for the US economy. Do you think we have sufficiently repriced earnings expectation going into earnings season?
I think in the shorter term, we have likely brought expectations down to the point where they're going to be beatable. I think, though, the question is, we're going to be hanging again on what we're going to hear about what the world looks like 6 months from now or 9 months from now. And the average stock is actually not particularly cheap. If you look through, the index itself has gotten cheaper. If you look at the S&P on an equal weighted basis, that's trading at 18, 19 times. The average is a lot closer to the market than it's been in the past. And I think that comes back to the rise of passive. And I do think becoming more active is going to make a lot more sense as we try to figure out who has a story, who can navigate, and where you have that flexibility.
Another way of asking what John just asked was, we've been talking to people who say Wall Street has reduced their GDP forecasts pretty much across the board. Yep. We haven't seen earnings revisions that match that. Which goes to which? Do those earnings revisions have to come down to meet the GDP estimates that have also come down?
Well, I think if I go to what the Fed told us, which I thought was a really nice summary, growth is going to be slower, but inflation is going to be stickier. And so I think companies are going to have some pricing lever to still try to make use of. I do think that we came into this year expecting roughly 12% growth. I was thinking it might be a little bit lighter than that. And so to the extent we are coming down to something a little closer to a more conservative outlook, I think is going to be helpful. I would rather that realization be more drawn out rather than very compressed. When we think about a 10% decline in 14 trading days that we got through the middle of last week, that was a very, very dramatic, not quite panic in the streets, but we were trying to reprice things really quickly. It's going to be messy over the next, call it 3 weeks, effectively, because we know that we have tariff day, which will effectively set costs. And unfortunately, we're putting tariff day right before earnings and right in the middle of the corporate buyback window is shut. So to the extent anything hits the market, your only buyer is going to be institutional money rather than corporate money, taking advantage of where they think expectations might be low enough, and CEOs can say, my stock is too cheap.
All I can say is Tariff Day is going to have to stick.
It's called Liberation Day.
Liberation Day or Tariff Day or Day of Uncertainty Resolution, maybe.
D-Day was Day of Days, so maybe we'll leverage that one again.
Let's not. So going forward, let's make it more simple because my mind is tired, and I think that everybody's minds are tired, and it's all a very complicated story. The bottom line is you see opportunities to buy.
Yeah.
And that, I think, is really interesting. And the areas that you do see opportunities to buy are some of the areas that people really loved coming into this year, like financials. Why?
I think financials still benefit from the prospect of deregulation. I think that is a direction we're going to get, even if we don't know fully the timing. We're trying to engineer a positively sloped yield curve, even if it's actually inverted again, at least if you look at the 3-month 10-year yield. I do think in the shorter term, financials wind up being a really interesting call on volatility. To the extent you have trading desks, and we're trading 13, 14, 15 billion shares a day, financials are sitting in the sweet spot of collecting that little fee on commissions, on data. Not to quote Duke and Duke, but they get paid effectively, whether the client makes or loses money. I probably shouldn't quote trading places. Oh well.
Jack, you mentioned
taught me a lot about investing back in the early
You
80s.
mentioned deregulation. So do you need to sit back as a portfolio manager and think of the triangle we're seeing in terms of Trump policy, which is deregulation, tax cuts, and tariffs, and not look at the everyday truths when it comes to potentially what's happening in terms of frenetic behavior on tariffs?
Life would be so much easier if we were trying to deal with this uncertainty if we were at 11 or 12 times earnings rather than 20. And so the reality is, as much as we try to triangulate on whatever the most recent data point is, and recognizing policy has shifted between a post at 10 and a post at 2, which reverses some of those policies, we come back to expectations remain robust. And effectively, that's forcing people, I think, in the shorter term to react rather than respond. I'm trying to respond. I'm trying to respond to things that are cheap, that effectively try to give me some of that greater, I won't say margin of safety, but margin of buffer to having to be specifically right on direction, timing, and level. So financials wind up giving us some opportunities to do that with bank stocks trading at 60% of a market multiple, when normally they might trade somewhere closer to 75% of a market multiple. Some industrials have gone from down 25, 30% on realization that maybe some of the enthusiasm around CapEx is going to be deferred a little bit. Some healthcare names where you're thinking, all right, we have to find billions upon billions of dollars to somehow cut in order to have tax cuts. And yet then you realize once you give a voter something, taking it away makes you very unpopular. And so I think, waste, fraud, and abuse is going to be quoted a lot in terms of what you look for, but you're probably not going to find quite as much of it as you would like to find to try to cut spending by a couple $100 billion. So to the extent that stocks got cheap coming into this year, healthcare was the worst performing sector last year. This year, it's the best performing because, again, kind of insulated to some extent, we thought. And then we suddenly realized that Ireland exports us a tremendous amount, or we import from Ireland a tremendous amount of pharmaceutical products and intermediate goods. Oh, well, that's going to be an interesting thing to try to work through on Liberation Day.
Speaking of spending, let's talk about spending. This headline just crossed from Germany. It passes the upper house. They've approved a debt reform bill, a landmark spending bill passing the final parliamentary hurdle. That's what the big red headline reads on the Bloomberg terminal. And I have to say, I didn't expect ever to read that big red headline on a Bloomberg terminal, unlocking hundreds of billions of euros of spending on defence and infrastructure in Germany, of all places.
With very little dissent. That's the shocking part. This has sailed through both houses of German parliament at a time where everyone is saying, A, we need to invest more in our military, and B, it is time to break that debt ceiling that we have. What is the implication, though, for the rest of Europe? And I think a lot of people are grappling with. And what is the implication for yields globally at a time of re-leveraging in places like Germany?
T. Rowe Price saying maybe 6%.
I saw that.
Yeah, that's quite a headline.
Yeah, saying that in the next year and a half, you could get to 6% on U.S. 10-year yields, in part because of what's going on over in Germany. How much does it set a floor under how low yields can go?
The euro at the moment just a little bit softer. We're down by 0.2%, 108.33 on euro dollar. Jack, it's always good to see you, sir. Thanks for dropping by. Jack Caffrey there of JP Morgan Asset Management. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. London's Heathrow Airport is closed and will remain shut all day. A major fire at a nearby electrical substation led to a major power outage at one of the world's busiest airports. Heathrow said disruptions would continue over the coming days and passengers should not travel to the airport under any circumstances. Meanwhile, here, President Trump signed an executive order to largely dismantle the Department of Education as part of efforts to overhaul the U.S. government. The order follows an effort to slash the department's workforce by nearly half. The plan faces legal and logistical hurdles, though, including potential clashes with labor unions and lawmakers. And let's get a check on Nike shares. They are down 5.5%. The sportswear maker issued a weak outlook for the current quarter as its turnaround efforts face a growing list of challenges. It's struggling to clear out old inventory and is feeling the impact of the growing trade war, with Nike producing some of its shoes and other items outside the U.S. in places like China and Mexico. That's your Bloomberg Brief. John?
Yahara, thank you. And Lewis Hamilton pole on the sprint race in Shanghai. So great news for Ferrari. It's one of those stories that I'm just going to discuss with myself. Up next on the programme.
That was fun.
Doubling down on April 2nd.
The president has been very clear about his intention for April 2nd. The president will be highlighting the unfair trade practices, the ways in which America has been ripped off by every country around the world, quite frankly. And there will be big tariffs that will be going into effect.
Liberation Day, April 2nd. Dan Clifton of Strategas, a bad company, joins us next from New York City this morning. Good morning. Equity futures on the S&P just a little bit softer here. We're down by 0.2% and just about positive on the week so far. And on course to snap a 4-week losing streak on the S&P 500. We'll see if some of this sticks. On the Nasdaq, we're down by about 0.25%. Under surveillance this morning, doubling down on April 2nd.
The president has been very clear about his intention for April 2nd. It's going to be a big day for our country. There will be big announcements when it comes to reciprocal trade, and the president will be highlighting the unfair trade practices, the ways in which America has been ripped off by every country around the world, quite frankly, and there will be big tariffs that will be going into effect.
So here's the latest this morning. The White House doubling down on reciprocal tariffs coming April 2nd. Implications of President Trump's current levies coming to light. Data showing China's imports of US cotton, cars and some energy products plummeted in the first 2 months of the year. Bloomberg's Tyler Kendall joins us now from Washington for more. Tyler, do we have additional clarity on what we might actually see in a few weeks' time?
No, April 2nd, we are still waiting to find out what those actual rates would be. Senior administration officials have floated that some rates could be higher, some rates could be lower, depending on how countries are negotiating. Scott Bessent, for example, highlighting that there could be a dirty 15, as he said, top 15% of countries that do the bulk of the trade with the U.S. We know China, of course, is one of them. And some of those statistics that you referenced there are pretty staggering. According to our Bloomberg analysis of the data, this could be a prelude to some widespread disruption in global trade. Chinese imports of cotton down about 80%, Chinese imports of vehicles down 70%, and Chinese imports of crude oil and LNG down about 40%. There's a lot at play here. We talked about April 2nd, but that week could start a little early for Beijing. You'll recall April 1st is when the U.S. is set to release its review of the trade deal struck with China under the first Trump administration, where we saw Beijing largely miss some of its top purchase obligations with the U.S. Bessent has floated that he could potentially put into place some sort of catch-up provisions there as a remedy to get those purchase agreements up, particularly when it comes to U.S. agricultural goods. John, we could get some more information about exactly where these talks stand and what both sides are willing to negotiate here, because U.S. Senator Steve Daines, a Republican from Montana, he touched down in Beijing overnight. He is set to become the first U.S. official to sit down publicly with a top Chinese diplomat of this Trump term. It is expected to be a rare opportunity for some direct talks.
Tyler Kendall down in Washington, D.C. Tyler, appreciate it, as always. To build on this conversation, Dan Clifton of Strategas, a bad company, joins us around the table. Dan, good morning.
Good morning.
What do you tell clients about what happens in 2 weeks' time?
Yeah, look, I think there's a disagreement amongst investors about what could actually happen. So we break them into buckets. There are 5 buckets: China, USMCA, reciprocal, sectorial, which is pharma, autos, semiconductors, and then you have commodities: steel, aluminum, lumber, copper. You have to put them in each of the buckets. Then what you do is you add them up and say, how many tariffs could we be facing on April 2nd? It's like $250 billion. You're talking about almost 1% of GDP. So I don't expect you're going to get all 250, but nobody's done that analysis. And so what we did was we went line by line into each country and said, where is the reciprocal nature of it? $11 billion in China. So that would be on top of the $30 billion that's already happened. Interestingly, Mexico's just $1 billion. Very small, largest trade partner. So there won't be much reciprocal. So when we hear some numbers are going to be high, some numbers are going to be low, that makes sense based on trade. India, Vietnam, they're going to have high numbers. Then you incorporate the value-added tax to it, and they're trying to find the border adjustability to it. When we did that, what we found was that Ireland has the highest rebate because of the pharmaceutical products. Germany has the second because of auto products. So you can see how the sectorial can start to merge into the actual reciprocal. This is going to be a big event. From our vantage point, what we're telling clients is if we get a deal on USMCA and can take that off the table and then have reciprocal, you're just swapping one for the other. But if you have both, the markets could be surprised by how big these tariffs are, largely because we're talking about them in isolation. We haven't combined them, and it is a bit of a shock. Here's the one reason why I don't think we'll get a shock. They moved away from a universal tariff to reciprocal to avoid the shock. And they're hoping that by threatening this out on April 2nd, it forces a negotiation. And maybe some countries will negotiate.
But we already know they're in negotiations now with some countries. Who do you think could potentially lower their tariff barrier for the United States before April 2nd?
The UK would probably be first. The UK is about 1.1 billion. It's relatively small. It's not high on the list. The key question is whether the 7 countries that are high on the list do. That's China, unlikely. Mexico, Canada, EU, unlikely to have a deal with EU by April 2nd. And then Brazil and India.
We spoke to the former Swiss ambassador to Trump 1.0, Ed McMullen, yesterday, and he talked about it's less about the EU and more of a bilateral relationship. So, say the United States with Italy, United States with Germany, United States with Switzerland. Are those conversations happening?
Absolutely. And by the way, when the president talks about saying he's going to give a rate, he's going to give a rate for each individual EU country. So this is a big change, and it goes right to that bilateral negotiation. And that's important because different countries have different imports that are leading to what they're trying to clamp down on, and that's the U.S. trade deficit. Sometimes they got to go after tariffs. Sometimes they got to go after products. If you look at Ireland, they don't have a tariff rate problem. They do have a large trade deficit because they're sending so many pharmaceuticals. So you've got to be careful. From a macro perspective, too big, you start putting recession risk in there. If it's too much on one industry, you start having supply shortages of pharmaceuticals. So you want to be very careful. But I would also caution, it's not just about trade policy. What the Fed did with its balance sheet this week was very important by slowing down QT. And on top of that, we're going to start tax negotiations in 2 weeks from now. And there's probably going to be some offsetting there.
I want to pick up on the Fed point.
Sure.
President Trump, a couple hours ago, came out in Truth Social and said egg prices are way down, groceries and gasoline are down. Also, now if the Fed would just do the right thing and lower interest rates, that would be great. If I were overanalyzing the situation, I might suspect that he's trying to get ahead of the potential shock and the potential weakness that could come with this huge bazooka on Liberation Day or Tariff Day or whatever you want to call it. Is that your take on it as well?
Yeah, the president is trying to change Biden's policies. Biden's policy was big fiscal, tight monetary. He wants to reverse that. Tight fiscal, loose monetary. That tight fiscal is spending cuts and tariffs. And then he wants the Fed to actually lower rates. Now, you've got to give space, and this is why Secretary Bessent is doing such a great job in trying to get oil prices down. You get oil prices down, you start to bring inflation down. You bring inflation down, you bring interest rates down, and you give the space for the Fed to be able to cut. I think the Fed's going to wind up having to cut 3 times this year, and they just got rid of QT. So you are seeing a more accommodative monetary policy. And my sense here is on fiscal policy, it's going to get a little bit tighter.
Just quickly, we're against the clock, 30 left. After April 2nd, are they done? Or does this just carry on?
This never ends.
This never ends.
Right? And the question is, what comes into place on April 2nd? What gets 30, 60, 90 days? If the president announces this and gives 90 days, the markets are going to cheer that. Now, you still don't have the certainty, but it shows you that there is a negotiation. And that's what the market just wants to know how much expenditure is going to be. The key issue that once you get the rules, then companies can plan, and the companies are frozen right now, and that's what we got to get out of. And that's why I think people are excited for April 2nd.
That's what we want. We want to play the game. We just want to see the rules. Dan Clifton, it's good to see you, sir.
Thank
As
you.
always. Dan Clifton there of Strategas, a bad company, breaking down Liberation Day a few weeks away.
You know, and just how much is going into this and what is potentially going to transpire in growth. Can you put the genie back in the bottle, though, of some of these trade negotiations once it's out? That's my question.
Up next on the programme, we'll catch up with Nouriel Roubini of NYU Stern on his call for a North American Economic Union. Stay tuned for that. Live from New York, this is Bloomberg. Equity futures this Friday morning, and good morning to you. Just a little bit softer, down 0.25% on the session. On the week through Thursday, just about positive on the week so far, following 4 consecutive weeks of losses. That was the longest weekly losing streak going back to August of last year. On the Nasdaq this morning, negative by 1/3. In the bond market, 2-year, 10-year, 30-year, just a flavour of the yield curve this morning. Yields are lower by about a basis point across the curve. On a 10-year, 422.33. On 2s, around 3.95. On our radar this morning, President Trump repeating his call for the Fed to lower interest rates. Writing on Truth Social overnight, the prices of eggs, groceries and gasoline are down. His comments coming as Fed officials weigh the impact of tariffs on the U.S. economy. I think this is the second time in 2 days we've heard these comments from the president.
Which is really interesting in light of the timing, less than 2 weeks ahead of Tariff Day. And that, I think, is what people are coalescing around. How much is this President Trump trying to get ahead of a potentially massive number that they're going to announce on April 2nd that is going to surprise people to the downside at a time when a lot of companies are warning about inflation ticking up, and that is becoming a theme. That's what a lot of people are taking away from this.
But at the same time, Tariff Day or not, Trump was always going to be calling on the Fed to lower interest rates. That is his worldview on he thinks interest rates are way too high. He said that not just in his first term, but he said that on the campaign trail. I would note, though, he's talking about egg prices being way down, gasoline prices being way down. So I think he's trying to shift some of the political blame to the Fed. Well, it's their fault because I got some of these essentials lower. When it comes to egg prices, though, they are not down in the grocery store, but they are down when it comes to the wholesale.
We're used to this. We've heard this so many times. We talked about this yesterday. We're almost desensitized to it at the moment. Senator Warren seems to write a letter every other week to Chairman Powell. Feels that way. I know it's not that way, but feels that way, asking for lower interest rates. It seems to be happening all the time now.
He restrained himself, though, for a couple weeks. He didn't talk about that. And he actually was talking about how the Fed's in an okay place because they're targeting the 10-year yield. For him to come out right now, tying it to inflation and other prices, how much is this intentionally trying to get ahead of something that's coming?
Let's get you the latest on Tesla as well. So Elon Musk is asking Tesla employees to hang on to their stock despite, quote, rocky moments. Shares plunging more than 40% so far this year. The Attorney General, Pam Bondi, also announcing federal charges against 3 people for alleged arson and vandalism of Tesla property.
I think we can all agree you shouldn't be vandalizing any sort of property. But when it comes to share prices, what you do with your money is absolutely yours, your prerogative. What I would say is what Elon Musk is trying to do is he's trying to get in front of this. This is what Dan Ives said. Get back to the floor, go to the Tesla headquarters, and please try to right this ship. He says if you read the news, it feels like Armageddon, which I thought was interesting. He says he can't walk past a TV without seeing a Tesla on fire. Understand if you don't want to buy our product, but you don't have to burn it down. But telling his company, please hold on to your shares.
Is this Musk actually recognizing the damaging in confidence toward his company after a 40% plunge in his stock price? I mean, is this him recognizing that he needs to be more present, or is this him playing momentary lip service at a time to try to stave off some of the liability? That ultimately will make a big difference.
Well, for Dan Ives, it was. He said this is a first step for Musk to show he's going to lead Tesla through this tumultuous period. Will we see more of this? I'm not sure because he's going to be in Washington today at the DOD.
This is a change of tone for the analyst community. And I'm thinking of Dan Ives, I'm thinking of others too, who only a number of months ago said there was a halo effect over Tesla stock because of Elon Musk's involvement with the government. That's changed very quickly in the space of a couple of months.
Because Teslas and Tesla vehicles have been used as the poster child of people's dissent and disagreement with Elon Musk. I will say it probably, I don't know if it helps or hurts to have Howard Lutnick hawking your wares on Fox News, where he urged viewers yesterday to buy shares in Musk's car maker, saying it'll never be this cheap again. It's sort of a question, again, and I think that you asked the right one. Is it becoming more of a liability than it is an attribute at a time where we're not seeing full self-driving vehicles really come to the fore in the near term?
Old habits die hard. The Commerce Secretary used to make in stock pitches.
Exactly.
Right?
I can imagine him going on being like, I got this.
It's not the job anymore. Anyway, the stock is down in the pre-market by 0.75%. Wanted to get you the latest on this. Some real travel disruption overnight. London's Heathrow Airport facing its worst disruption in at least 2 decades after a nearby fire caused a major power outage. Authorities saying the airport will be closed all day today, with service interruptions likely to continue for days.
This is catastrophic for the thousands of people who go through Heathrow every single day. A question, and we've all been talking about this. You read this earlier, that Heathrow said in a statement, The disruption will continue over the coming days, and passengers should not travel to the airport under any circumstances. It sounds pretty dire. And it raises this question, how long is it going to take for all of these disruptions to get resolved, given what you mentioned, all of the staff, all of the pilots, all of the flight attendants who need to get into place and the connecting flights? What a disaster. But again, why do they only have one energy source to really power the entire network in one of the busiest airports in the world?
It's one of those questions I think we all want answered, so let's try and get you an answer. Joining us now is Bloomberg's Alex Morgan. He joins us now from Heathrow Airport. Alex, welcome to the programme, sir. Let's just start with, how on earth did this happen?
Well, good morning, guys. I mean, this is the fourth most active airport in the world, Europe's busiest airport, and if you look behind me, you'd be forgiven for thinking nothing's going on. Nothing is going on. The skies are completely clear. This is unprecedented. It's a full-day closure. So we've seen disruption to air traffic control. We've seen the airport shut, say, for example, during the visit of President Obama in the past. This is a full-day closure, completely unprecedented. And as you were mentioning there, it's sort of like a chain of dominoes, really, because this fire at a power station, a power substation, took the airport offline. So that's going to take the airport off for the day. But then you've got the aircraft. Then you've got the crew for those aircraft and the passengers, now all in the wrong place. It's not simply disruption throughout Friday, which of course is happening. Indeed, 120 aircraft, around that number, were already headed to Heathrow and had to turn back at the time of the closure. But it's then the knock-on for the next couple of days. Heathrow, the statement saying closed until at least midnight tonight. Now, the fire brigade here in London saying that the fire is under control. They're now looking to investigate the cause of that fire. And that, indeed, as you already mentioned, going to be questions about the power source for the airport. But so many questions, as you're saying, about when will normal service resume. I think it is fair to say we're looking at disruption well into the beginning of next week. On average, Heathrow at peak times has around 40 aircraft taking off an hour. I mean, this is a hugely busy hub for travel, of course, transatlantic, but also to the Middle East as well. You're seeing all the airlines issuing updates to their customers. British Airways, by the way, this is home to British Airways. More than 600 flights for that airline alone impacted today. This is unprecedented disruption. When is it going to finish? That's a question everybody wants to know. It's fair to say we're looking at days, not hours.
Alex, appreciate the update, sir, and the coverage throughout this morning out of London. Bloomberg's Alex Morgan. In the next hour on Bloomberg Surveillance, we'll catch up with Guy Johnson and we'll bring you regular updates on what's happening at London Heathrow throughout this morning on Bloomberg TV. For the markets, equity futures right now just a little bit softer by 0.4%. Investors confronting an increasingly cloudy outlook for the global economy, just as President Trump pushes ahead with a fresh wave of tariffs. Nouriel Roubini of NYU and Hudson Bay Capital proposing a solution, writing, quote, to resolve their current tensions, Canada, Mexico and the United States should start drafting plans for a North American economic union. Nouriel Roubini joins us now for more. Nouriel, welcome to the programme, sir. Thanks for making time for us. That's quite a statement. Just go through the way you're thinking about it. How on earth would this work?
Well, for now, we have only a free trade area between U.S., Canada and Mexico, and there are already tensions involved. There's nothing, not only to do with, of course, drugs, fentanyl, and migrants, but the U.S. is also concerned about the trade imbalance between Mexico, U.S., and Canada. They're very large trade surpluses with the United States. So you can renegotiate the USMCA in a direction of restricting trade, and U.S. is now probably asking Mexico and Canada to also restrict trade in automobiles. There may be 20-25% tariffs on that because there are lots of job loss in the U.S. Or you can do something that is more bold, forming a full economic union that would imply free trade not only in goods, but also in services, in the movement of capital, labor, data, technology, and information. That's what the European countries have done for the last few decades. And from any economic point of view, North America is an optimal trading area that goes beyond goods. Now, one step you can take along those lines before having a full economic union could be, for example, to form a custom union. What's the difference between a custom union and a free trade area? In a free trade area, there is no common external tariff against other countries. So, for example, there are lots of Chinese cars that are now entering into Mexico, while the U.S. has a 100% tariff against Chinese EV. If you form a custom union, the first step for economic union, you'll have to have the same tariff imposed on Chinese cars, whether they go to Mexico or U.S. or Canada. And in this way, you create a full market, for example, for automobiles, and you prevent the imposition of, say, 20-25% tariffs on exports for Chinese cars or parts from Mexico to the United States. So you can do a reform of the trade agreement in the direction of shrinking trade, or you can do it in a direction of expanding trade. And I argue that actually it's an economic benefit of all three countries to expand trade through first a custom union and then a full economic union.
You offer a different vision then first, before we get to the much bigger one later. Can we just talk about the much bigger one? Freedom of labour, free movement of labour between the United States and Mexico just sounds like a complete non-starter. Nouriel, do you actually think that could be a stepping stone further out down the road in the future?
Well, in the case of the European Union, you had the same problem. The countries that were much poorer in Central Eastern Europe, they joined the EU. There was a transition period of many decades until they reached a certain level of per capita income, a certain level of governance, a certain level of reform. Of course, free trade in labor between US and Canada would not be a problem, same per capita income, same culture, language. And actually, there'll be probably more people going from US to Canada than the other way around because of global climate change and cheap land in Canada. With Mexico, of course, at current level of per capita income, you cannot have free trade in labor. But as I said, like in the case of Europe, you could have standard criteria that suggest that maybe after 10 or 20 years, when Mexican per capita income is much higher, there's better governance, then you free up that type of trade. So I'd say that in economic union, the part that is controversial is only probably migration of labor. It would be in the interest of the United States to have free trade in goods, in services where it has comparative advantage, in the movement of capital, portfolio and FDI, and of course data information technology, where the US has a major comparative advantage relative to Mexico and to Canada. The only controversial part, as I said, is labor movement, but you can restrict it over time.
Nouriel, do you get the sense that anyone in the current administration is sympathetic to this type of proposal at a time where it seems like people are increasingly going for economic isolation rather than reducing the walls entirely?
I will start conversation within the administration on this matter, but I would say that certainly a step towards reforming the USMCA in the direction of a custom union makes sense. Because right now, of course, the automakers, that are the producers, are very worried about the impact on their own production costs and profit margins of restricting and imposing a lot of tariffs on, say, auto trade. The unions and the workers are in favor of it. But the problem is that if you're imposing this 25% tariff on automotive trade, the cost of cars in North America is going to increase by 10, 20%. That's going to hurt, first of all, consumers, but it's going to also hurt the workers. So if you care about U.S. auto workers, there are two options. One, to impose the tariffs and restricting trade in automotive, but that's going to be bad for everybody. Another one is instead having a custom union, where if you essentially have an external tariff that is common against Chinese autos, then Chinese autos that are not entering the United States today will not enter Mexico either. And therefore, the market for U.S. automakers is going to be much bigger because you have 120 million Mexicans that need auto and are buying now mostly Chinese cars. So you can have a win-win solution that makes everybody better off, including the auto workers, if you go in the direction of a custom union and eventually an economic union. So you have to go forward rather than going backward. And I think that those arguments can be made in Washington, in Mexico City, and of course in Canada as well.
Nouriel, is this proposal potentially a way that the United States could have more heft when it comes to driving a wedge between Beijing?
Well, certainly one of the concerns that the United States has is not just fentanyl that is coming to the U.S. Via China, but more importantly, that the Chinese have avoided tariffs by essentially exporting goods to Mexico and from Mexico to the United States as if they were Mexican goods. The Mexican production of many goods has a lot of content of parts that is Chinese. And there is also concern about the fact that the Chinese are taking over the auto market of Mexico as well, exporting cheap cars, EVs and otherwise, to Mexico. So if you care about de-risking the relationship with essentially China, whether it's in auto or other critical parts of the economy, it makes sense to have initially a custom union and then having also a full economic union where decisions about how much you trade and do investment with China from North America are done not by the U.S. side alone, and then Mexico can do whatever they want as they do right now, but have it in the context of an economic union and initially a custom union. So it makes sense for the US, it makes sense for North America.
Nouriel, provocative as always. It's good to catch up with you, sir. And I should say, thanks for making time for us. I know you're on a bit of a world tour, so looking forward to catching up with you when you're back in New York. Nouriel Roubini there of NYU Stern and Hudson Bay Capital. Two very different ideas. In Nouriel's mind, one informs the other. The first point, though, a customs union, I don't think that's a million miles away from where we might end up between the United States, Canada and Mexico. There is a sense that this is just opening the negotiations back up for USMCA.
Absolutely. And also, remember what Scott Bessent recently said? He said you can make a fortress North America. He liked what Mexico was thinking of doing in putting tariffs on Chinese imports into Mexico so they don't come into the United States. And he said it would be a nice gesture if Canada did that as well. So if you had Canada, the United States and Mexico all having the same tariff level when it comes to China, that solves a huge problem for this administration.
That's the latest from Professor Roubini. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hacker. So, Yahara.
Hi, John. We start with FedEx. Those shares are down 8% in the pre-market after the company lowered its full-year guidance for a third straight quarter. They expect adjusted earnings for the year will be lower than analysts expected as inflation and uncertain demand for shipments squeeze their bottom line. Meanwhile, Apple is said to be undergoing a rare executive shakeup in a bid to get its AI efforts back on track. Sources telling Bloomberg that Tim Cook has lost confidence in the ability of AI head John Giannandrea to execute on product development. Vision Pro creator Mike Rockwell will now take over Siri. And UBS is considering relocating its headquarters if Switzerland sticks to its demand that the bank holds an extra $25 billion in capital. Sources telling Bloomberg that executives believe meeting this requirement would make the group uncompetitive to global rivals. That's your Bloomberg brief. John?
Hey, Yahara, thank you. More from Yahara later on in the programme. Up next on the programme, the critical mineral push.
Moments ago, I also signed an executive order to dramatically increase production of critical minerals and rare earths. It's a big thing in this country. We're also signing agreements in various locations to unlock rare earths and minerals and lots of other things all over the world.
We'll get you some clarity on this push in just a moment with Timna of Wolfe Research. She joins us next, live from New York City. This is Bloomberg. So here's the state of play. We're down 1/3% on the S&P. We're down 0.4% on the Nasdaq through yesterday. The Nasdaq 100 heading towards a fifth consecutive week of losses, something we have not seen at least since May 2022. It's been a long time. We're down about 1/3 on the S&P. Under surveillance this morning, the critical mineral push.
Moments ago, I also signed an executive order to dramatically increase production of critical minerals and rare earths. It's a big thing in this country. We're also signing agreements in various locations to unlock rare earths and minerals and lots of other things all over the world, but in particular Ukraine, which they have tremendous value in rare earth, and we appreciate that.
So here's the latest this morning. President Trump making a push to secure critical and rare earth minerals, both at home and abroad. Trump signing an executive order to expand production in the United States while adding a minerals deal will still get done with Ukraine. Timna of Wolfe Research joins us now for more. Timna, we hear the president sometimes say rare earths and critical minerals. Can you just start there? What's the difference between the two?
I think it's just a question of what you decide to define as critical minerals. So I think in the past, there's been some discussion of critical minerals, including copper and sometimes including aluminum. So I think it really depends on the definition, who's using it in what way. I think, in terms of rare earths, yes, I think those can be considered critical minerals. This could include a wide variety of critical minerals, but I don't think I can entirely interpret what President Trump's alluding to in these clips.
When it comes to Ukraine, he says this deal can happen very soon, very shortly. What kind of minerals are we talking about that Ukraine has?
It's not my understanding that Ukraine actually has a lot of rare earths, and I don't know Ukraine's situation. I do know that the U.S. has actually ample supply in the earth of rare earths. Rare earths tend to be located in conjunction with coal deposits. So there's, of course, a lot of coal deposits and increasingly coal deposits that may or may not be viable in the future or likely. But I think it's fascinating to see that the rare earths in the U.S. could be further expanded. There's only, one large producer in North America right now, and that, there's a lot of smaller projects. So I think we could be seeing, if there's support from the administration, just a proliferation in the rare earths production in this country.
Well, he's invoking emergency powers in order to boost that domestic production. How high could you see the United States reach in terms of boosting that production of these minerals?
I think it's a question of the confidence in the industry that these are going to be sticky policies. So, it's really tricky to make an investment not knowing how long some of these policies are in place. And the reason you haven't seen these investments happen so far is that China just dominates rare earths, right? So like 90% of the world supply and production comes out of China. So you'd have to see some subsidization of domestic production to be able to encourage them to get to those levels. I don't know the deposits in the ground and if we could quite get to that level, but I think you could see just a boom in production in the near term. But they still have to develop it. You still have to mine it out of the ground and get to a point. So usually, developing mines like this would take several years. So we're probably still talking about any palatable actual solution, usually I would think later in his administration.
Timna, do you have a sense, based on what you've heard so far with the tariffs, as well as some of the deals that are happening, whether it's what might get signed with Ukraine, whether it's just discussions to explore elsewhere, do you have a sense of what the overarching strategy is for the United States and this administration to secure rare earths minerals ahead of what they expect to be an increasing tit-for-tat trade war?
Well, I just would imagine if you're the Trump administration, you see the world dominated by China and kind of an important production, right? Rare earths, of course, aren't that rare, but they do make very important magnets used for high-tech applications, robots, computers, you name it. So this is something that, of course, we're imagining that we're going to be needing, much more going forward. So I think the goal should be to encourage domestic production. I think there's a lot of other ways to do that by, subsidizing them directly, by reducing the regulations to actually mine it. That's the problem on a more local level. And I think, if you look at the importance of this industry and the fact that it's so dominated by China, I can imagine why we want to encourage domestic production. I just think it likely takes time. So you probably want to avoid all the tariffs until you know that you can have a thriving domestic industry.
It takes a long time, particularly in the US. I'm thinking of Resolution Copper in Arizona. Timna, just to finish there, the 30 seconds we have left, if you wanted to play this story through equities domestically here in the United States, what are the names of the companies you do that through?
Well, there's only one domestic producer of rare earths, and that company has a big head start, ahead of everyone else. That's MP Materials. And then I think the other way to take a longer shot is these coal companies that have the deposits that could eventually get produced. So I don't cover those names, but there's quite a few companies that have coal deposits that, I'm sure we could look up.
Timna, appreciate the clarity. Thank you. I'm sure everyone's going to Google right now Timna Tanners of Wolfe Research, or go on the Bloomberg terminal, of course. Up next on the programme, Seema Shah of Principal Asset Management, Adam Hodge of Pulpit International, Jeetu Patel of Cisco, don't miss that on AI, and Greg Peters of PGIM Fixed Income on financial markets worldwide. Live from New York City, the second hour of Bloomberg Surveillance. Up next.
We're in the midst of a pretty significant set of shocks.
The elements that normally tip bull markets into bear markets are not present. The biggest challenge, though, is how policy unfolds.
I'm not super bearish on risk assets for the next 6 to 12 months. I think it's a slowdown, not a recession.
We're going to be in this environment where it's heightened uncertainty for equity markets. We think hedging is something that investors should be very focused on.
This is a point-in-time moment, and then we're going to go back to business as usual.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now with equity futures negative by 0.25% on the S&P 500, hoping to avoid another week of losses on the S&P. We are on a 4-week losing streak coming into this week. On the Nasdaq, we could well make it week 5. The Nasdaq 100 negative by 0.4%. The President of the United States for a second consecutive day making the argument on Truth Social for lower interest rates.
And this comes after the Fed indicated they are on hold, talking about President Trump was talking about prices of eggs coming down, gasoline coming down, speaking about whether this actually could be disinflation. Look, he's open to his opinions. Go for it. You are an American citizen. Comment on the Fed. Whether it actually affects the Fed, we'll see. Michael Reed of RBC saying we expect the Fed will remain on pause until the hard data forces their hand.
What did the Fed say? Nope. No, they not listening to what the White House is saying, whether or not that has to do with personnel or whether that has to do with where they have the direction of travel according to Fed rates. I'm not surprised we heard from the president yet again when it comes to where he wants to see the direction of travel. Why? Because his administration continues to tell you they want lower mortgage rates. They want to see money going back into the system, especially for middle Americans. And to Lisa's point earlier, a lot of this has to do potentially to what they have coming up in 12 days' time. The big one, Liberation Day. Tariffs.
The Fed chair is not in a rush. He wants clarity on Liberation Day, April 2nd, work out what those tariffs look like, work out what it means for this economy. But we are getting some warning shots from corporate America, and we got a few more in the last 24 hours. Check out FedEx and Nike. FedEx, I think, for the third consecutive quarter, cutting guidance. FedEx this morning is down by close to 8%. Nike is going through its own world of problems, but they've got a list of complaints, and it includes tariffs. That stock is down by 5.8%.
You asked a very good question to start the last hour, which was how much of these are specific stories that are turnaround stories dealing with real competitive pressures, sandbagging us, and also using the convenient excuse of uncertainty. We won't necessarily know. FedEx is facing a lot of competition from Amazon. Nike is facing competition from pretty much everyone because they're trying to rejigger their complete corporate strategy. Nonetheless, when you do have a litany of companies all saying the same thing, it makes people feel insecure. And that, I think, is what you're seeing pretty much across the board.
It shows that the supply chain might be under pressure when it comes to tariffs, and also shows that consumers are under pressure when it comes to what you could see as this price hike. Nike talked about the fact that they are already starting to implement tariffs on imports from China and Mexico. That's where a lot of their goods are made.
If you're just joining us, welcome to the program. We'll talk about some stocks under pressure. IAG, Lufthansa, Air France, slightly softer, weaker, lower, down over in European trading. The news out of Heathrow, really shocking stuff. Closed all day due to a power outage caused by a fire at a nearby electrical substation. Serious disruption for worldwide travel over the next several days, potentially.
Yeah, the biggest disruption that we've seen in more than 20 years for the fourth biggest airport in the world, a major hub for all sorts of different routes. A question of A, when will it get resolved? B, how long will it take it for all the pilots and flight attendants and cargo ships and everything else that needs to get there? How long does it take to get through that? And then what are the ramifications for airlines that already are under pressure with consumers pushing back in a time of uncertainty? 1,400
flights, 200,000 passengers going through that airport every single day. Super messy, and plenty of updates throughout this morning on this program. Coming up through the next 60 minutes, we'll catch up with Seema Shah of Principal Asset Management, with investors very much on edge going into April. Bloomberg's Guy Johnson will be with us from London's Heathrow Airport as that airport comes to a standstill. And the Cisco Chief Product Officer, Jeetu Patel, on the company's latest partnership with NVIDIA. We begin this hour with stocks lower, struggling to snap a 4-week losing streak. Seema Shah of Principal Asset Management writing, whether the rally can reassert itself and deliver positive equity returns going forward will likely depend on whether earnings growth can deliver. Seema joins us now for more. Seema, welcome to the program. Can it deliver relative to expectations? So let's talk about expectations. Have they pulled back sufficiently over the last several weeks?
Hi, John. I don't know if it necessarily has. I mean, we've already seen a couple of downgrades to economic growth forecasts. Actually, from an earnings perspective, I don't think it's moved down enough, particularly when you start to think about the 2nd of April and the amount that could happen to global stocks, global earnings. So I think there's a little bit further to go. You know, we need to see a number of other, boosts coming in the second half of the year. But I think for the next couple of months, it's going to be a really rocky road.
Seema, some of the retailers have come out and said that the next year could be difficult. They've lowered expectations. Delta Airlines, the airlines group, have done a similar thing over the last several weeks as well. Which parts of the market do you think are more vulnerable going into earnings season?
So I think anything, of course, like which has got any kind of international revenue exposure, anything which is linked to consumers. The things that we're really concerned about with the consumer is just what we're seeing with regards to price increases, the pressures that people are having on household income. So actually it's spread across so many sectors because there's so much significant exposure. There are parts of the market which we think are a little bit less vulnerable. Places like financials, which have had a bit of a pullback, it could see some return. But so much really depends on what can we expect to come through from a stimulus perspective, not just from the Fed, but in terms of, what happens to tariffs in the second half of the year? Are some of them going to be lifted? Are we going to expect to see deregulation? If that comes through, then there are parts of the market that stand to gain over the coming months. But as I said, I think the jury is out until we have some further clarity of where this administration is going with a number of their different policies.
And there also needs to be some clarity, Seema, on some of those inflationary pressures that you were referring to, both with respect to households and what that does to their spending capacity, as well as to companies and their ability to pass it along to said consumers. Do you have a sense of whether so far some of these price pressures are actually inflationary or whether they have the seeds of being disinflationary down the line in tandem with weaker growth?
So actually, I don't think there is any clarity at all. I think we're hearing really contradictory stories. About a year ago, we were talking to a number of our larger clients who had told us that typically you can pass on price increases twice. Consumers can handle it twice. The third time is a complete no-go. And we're almost looking at that third time now. On the other hand, we are hearing some small businesses who are saying that there's so much uncertainty and they cannot be left out of pocket. So they're already starting to increase prices ahead of what could be reciprocation on tariffs on April the 2nd. So actually, it's a very, very varied story, which of course, it doesn't help businesses, companies, investors really plan ahead.
At the end of another week where my mind feels somewhat fried, I wonder if people are just getting sick of all of the uncertainty in the United States and are looking for the certainty of the budget that was just passed in Germany, the certainty of other regions in the world that might be engaging in fiscal stimulus. Do you jump on that train, or do you think that that sort of haven from uncertainty or just another story, another narrative, do you think that that's basically played out as people realize, okay, it's going to be more complicated?
So it's funny. I've been in Madrid all of this week speaking to clients, and it was interesting from their perspective. They're a little bit more skeptical than I'm finding the US audience to be. They're looking at this and they're saying, look, this is really great news for Germany, without a doubt. But in terms of how it feeds through to Europe, they're still unsure of really what the positive repercussions could be. They don't really think there's going to be major fiscal stimulus from their countries. And even if there was, they're worried about what happened to debt markets there. And on top of that, from their perspective, the real game changer that they're looking for is deregulation in Europe, which unfortunately is not something that they are particularly optimistic about. So I think there is some potential, certainly, that there's good news, at least on one part of the world rather than the other. But how far this can go in the near term, I think is questionable. And certainly we think there could be a near-term pullback for European equities as you start to see some reality set in around what's happening with tariffs and really, how quickly this fiscal stimulus can actually feed through to the German economy, let alone the European economy.
So, Seema, are you challenging this idea that the ball of exceptionalism is shifting over to Europe and China and elsewhere and away from the United States, that that's maybe overly simplistic and it's just getting more complicated with a less clear path to which area and which stocks are going to outperform? Is that kind of how you see things?
So I think that the near term is a little bit cloudier than many people have been thinking. I think the near term, there's been so much positivity around the fiscal stimulus news, but there's still, as you said, a lot of things with regards to the tariffs, how quickly the fiscal stimulus can be passed through, that in the near term, some of that optimism around international equities could take a bit of a setback. The other thing that we're thinking is that US exceptionalism shouldn't necessarily be in question. We do think that the US is still going to see superior growth going forward. But is it going to, does that necessarily stop European equities, Chinese equities from doing well? Even a move to benchmark positions for so many investors would be a significant tailwind for equities. So it's just that the world is a bigger place now. There are other opportunities for investors and if you haven't had a chance in the last couple of weeks to get onto that ride, you probably will see an opportunity within the next few months.
Seema, when it comes to the uncertainty in the United States around tariffs, is April 2nd then going to be a clearing event?
Well, on one hand, yes, we hope that there will be some kind of certainty coming through. That is the one thing which is overhanging, particularly for global investors or investors looking at international equities. So I think there'll be some clarity. Does it really clear up everything that we are waiting to hear? I guess I'm fairly pessimistic on that, but at least we're getting to a process that at some point within the next few months, we know some kind of direction where this administration is going, and then businesses can plan. So that's why for the second half of the year, we have a slightly more optimism because we think some of the uncertainty will clear up.
The life of a European-based strategist here, Lisa. Sprinkle of Madrid, a little bit of London, quick trip to Rome. Sounds all right, doesn't it?
Well, I think that we're both really tired.
Plus
I think
Germany's spending
sounds,
too, some deficit spending.
Just head over there.
It's all adding up.
Yeah, but as long as you don't fly to Heathrow.
Before, it didn't make sense at all.
Yeah, well, but I will say it's interesting that in Spain, they're not particularly interested in what Germany's doing as being the holy grail, considering that it doesn't necessarily open up the purse strings for them. And frankly, it might make them more in a difficult spot because of what spreads are doing on the periphery.
Seema, appreciate your time, as always. Seema Shah there of Principal Asset Management. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. London's Heathrow Airport suffering its worst disruption in at least 2 decades. Europe's biggest airport will be closed all day after a fire at a nearby electrical substation led to a major power outage. Heathrow said disruptions will continue for at least the next few days. Meanwhile, President Donald Trump has denied a New York Times report that Elon Musk will be briefed on the American military's contingency planning for a potential war with China. Defense Secretary Pete Hegseth also denying the report, writing on social media that the meeting is about innovation, efficiencies, and smarter production. And day one of March Madness was one to remember. 12th seed McNeese State upset number 5 seed Clemson, while Drake pulled off another stunning upset over Missouri, while Creighton dominated Louisville. Elsewhere, Kansas fell to Arkansas and Gonzaga beat Georgia. Day 2 of the tournament tips off at noon Eastern. That's your Bloomberg Brief. John?
Yahara, thank you. Gonzaga getting it done. It's good to see, isn't it?
They're on my bracket. The only time I ever hear Gonzaga.
I say it every year. It's not
every
a real
year.
school. Doesn't exist.
No,
Never met anyone that's been there.
Yeah, well,
I just come out for basketball once a year and dominate.
And they dominate. So
every time I say this, every year you send me hate mail. I'm just joking. I know it's a real school. Up next on the program, Trump versus the Fed.
Inflation is cooling. The numbers indicate that. And the president strongly believes in low interest rates. And I think the American public do, too.
That conversation up next with Adam Hodge of Bully Pulpit International from New York. This is Bloomberg. Closing out the week with equities just a little bit softer. We're down by 0.25% on the S&P, softer by 1/3% on the Nasdaq 100. This run of losses on the Nasdaq continues, though, down for 5 consecutive weeks, something we haven't seen going all the way back to 2022. Out of surveillance this morning, it's Trump versus the Fed.
The president has every right to criticize the decision, and he's made it very clear that he believes in lower interest rates are going to help this country boom. And this administration is working on lowering the rate of inflation caused by the previous administration every day. Inflation is cooling. The numbers indicate that. And the president strongly believes in low interest rates, and I think the American public do too.
So here's the latest this morning. President Trump ramping up the pressure on the Federal Reserve, posting for the second time in 2 days that the central bank should do the right thing and cut interest rates. Joining us now is Bloomberg's Tyler Kendall from Washington. Tyler, is this the new normal for Washington now?
Well, John, President Trump has long floated that he should have some sort of influence over FOMC decisions, even as his senior advisors contend that they do respect the Fed's independence. But of course, at the crux of this is that Jerome Powell this week said that tariff policy is already starting to impact the economy and economic projections, and we don't even know the full scope of the White House's plans yet. Now, I went through President Trump's Truth Social posts between now and the beginning of the year so that you don't have to. And the last time that he urged Fed officials to lower their interest rates, it was on February 12th. That is nowhere near an FOMC decision, but it was one day before President Trump instructed the USTR and Commerce to look into his reciprocal tariff plan. And in that post, he said that he felt that lower interest rates would go, quote, hand in hand with his tariff policy. Of course, this tracks with what Dan Clifton told you on this program last hour, which is that it appears President Trump is trying to pursue tighter fiscal policy with looser monetary policy. Now, just quickly for some additional context out of Washington to all this messaging around this, there are heightened concerns about the future independence of federal regulators after this week the Trump administration moved to fire 2 FTC commissioners who were supposed to be shielded by legal precedent from political firings. Of course, Chair Powell deferred on that question when he was asked this week, pointing us to his previous answers that he doesn't believe President Trump has the legal authority to fire him. John, we should note that President Trump has previously said at least that he intends to let Powell serve out the remainder of his term.
Tyler, thank you for going through the truths for all of us. And this is a point Lisa has been making all morning. When it comes to April 2nd, the Liberation Day, as the president's talking about it, what can you tell us about what we should expect?
Well, at this point, so the reciprocal tariffs, still a lot of questions about implementation and also the timeline. I said yesterday that I'd spoken to Kevin Hassett, who said that the goal is to have those tariffs in effect immediately, but we have gotten those suggestions that it could be more of a rolling process. He also told me, do not expect any carve-outs. At the moment, we know that the administration is negotiating. Some countries might see higher tariffs. Some countries might see lower tariffs, depending on how those negotiations go. We're, of course, tracking some key countries here and keeping in mind that those reciprocal tariffs will include those non-tariff barriers like regulations, lax IP protections, and importantly, of course, the value-added tax, the VAT tax, which could really hit the European Union countries particularly hard.
Tyler, appreciate the update. Thank you. Tyler Kendall there. Annmarie, I imagine it's pretty difficult to lobby this administration to do anything and change their mind on a variety of issues. There was a great piece in Politico just yesterday. If you missed this was the headline. K Street crashes into a nearly unlobbyable Elon Musk. Lots of people are trying to change policy down in Washington, D.C. This White House isn't blinking.
They're not blinking. And also, who do you call to change that policy? Individuals like Elon Musk is not going to be taking calls, really, from lobbyists. I don't think he cares as much. So I think your best bet is if you were a corporate executive to try to get on the phone with Susie Wiles or the president himself, if you're trying to lobby for something, which we did see the auto companies do, and they were successful.
I want to see Mike Wirth. What's his secret? Because he seems to be getting some traction down there. And that, I think, is interesting.
Yes, I agree with you. He was on this programme. We brought up the issue of Venezuela with him. You could tell that things were going to get moving on that front.
You know, he has a way. But there are people who are getting through. But there is often a reason that goes to some sort of geopolitical strategy, less than, say, it's going to hurt my business.
Let's get back to that tension between the Federal Reserve and the sitting president. Adam Hodge of Bully Pulpit International writing, attacking Powell and raising more doubts about the Fed's independence are a recipe for more uncertainty and market turmoil. Adam joins us now for more. Adam, welcome to the programme. We asked Tyler just moments ago whether this was just the new normal. We see Senator Warren periodically send a letter to Chairman Powell asking for lower interest rates. The president's been very vocal about it as well. Is this the new normal in Washington?
Well, I think we have to take a step back and remember in the first Trump administration, as Kendall was pointing to, we saw President Trump's attacks on the Fed's independence. And, largely, though, Jay Powell stayed in place throughout the rest of his term. But what we've seen in the first 60 days of the Trump administration is a trampling on a lot of those norms that we thought held up in the first administration. So I think there's a lot of questions about the Fed's independence and whether that will be durable throughout the president's first term. And I think that uncertainty is important. Just look at what's going on in Turkey. You all have been talking about it all morning. For the several years, President Erdogan put a lot of pressure on the central bank to take action to lower interest rates. And that plunged the Turkish lira and the economy into turmoil. That's something that we don't want to recreate here.
Hold on, Adam, are you comparing the United States of America to Turkey?
No, but I think you get down this road of injecting political pressure on the independence of the central bank. That makes investors nervous. That makes investors worry about whether you can predict the actual reliability of the central bank policy. That's the uncertainty that I think people are worried about.
Does it give you at least some confidence that the Treasury Secretary has talked about the fact that he's going to leave the Fed to itself? What we're seeing from Donald Trump is basically what we've seen from him throughout his entire course of his political career, which is he's going to share his opinion.
Well, look, I have a quick flashback to my days in the U.S. Treasury Department, where the Treasury and the Fed very much kept their lines of separation, and the Fed's Treasury Secretary did not talk about monetary policy. And conversely, the Fed never talked about the U.S. dollar. That was something that was, almost a golden rule. So I think, it's the importance for the Fed is important for the Treasury Secretary to speak to. But getting into what the Fed should or shouldn't do, I think, is a red line that shouldn't be crossed.
Let's put aside just the truths that are having to do with the Fed. It raises a question of what President Trump is trying to get in front of on April 2nd, when we do get a list of tariffs that hopefully will give us a bigger picture of what the actual landscape looks like. Adam, is there anything in the potential proposals put out there in the different buckets of tariffs and trade reorganization that you, with all of your experience at USTR, et cetera, the Treasury Department, that you agree with, that you think is the proper way to go about doing things?
Look, I think so you can think about it this way. You almost want to make like a March Madness bracket of potential options that the president could unfold, right? You have a potential 301 investigation, which would be of the normal process. You'd get a lot of feedback from different players in different countries, and it would take some time, but you would have a very clear, orderly process. And importantly, it would protect the USTR and the administration from any legal challenges to any of the tariffs that were put in place. I think you get into the other parts of the bracket, IEEPA or some of the Section 338, some of the other potential authorities, it gets a little bit trickier to figure out whether you actually have the president has the authority. And I think if there's a real bite in the bottom line from companies, you're going to see much more likelihood that they will challenge the process and the way that those tariffs were put in place. So my advice to the Trump administration, to the extent they're listening to me, is to go through a more structured, normal process. And that will also give the market, I think, a little bit more certainty that they can trust that this process is above board and that they know what's going to happen.
There's a sense that some of the playing field was not fair from a very long time with many different trade partners, and thinking about China and the U.S. in particular, but also other trading partners. I'm just wondering, when you look at the strategy of messaging from both the Republicans and the Democrats, do you think that the Democrats ought to embrace some aspects of what President Trump is doing, since those stuck actually under President Biden, and there does seem to be a sense that maybe some rejiggering makes sense?
I think what you saw from the first Biden administration was a clear embrace of some form of tariffs to help rebalance the trade relationships with some key partners and allies. But it was also coupled with key investments in our supply chains. Like, that is the missing link that I think you've seen so far, is how are you going to encourage domestic production, encourage a lot of the key investments that we need to have a robust global economy that can compete on multiple playing fields. So that is, I think, the key that has been missing so far. Democrats can embrace and should find the strategic reason for tariffs to rebalance certain sectors and certain parts of the economy. But wholesale reciprocal tariffs across the board just creates a whole lot of uncertainty. It's unclear whether the Treasury and Commerce and USTR can actually get that done in the amount of time that they have left. So that's, I think, where the uncertainty coupled with the lack of investments is really what I'm looking at.
Adam, appreciate your time. As always, thank you, sir. Adam Hodge there of Bully Pulpit International. Finish on the Democrats there. The numbers are just ugly for them. Over a quarter of registered voters, 27%, have a positive view of that party. These are some of the worst numbers we've seen going back to the 1990s. And
it comes as the Democratic Party is looking to try to coalesce around a message, but we haven't really heard it yet. And Chuck Schumer under a lot of pressure as a Senate Minority Leader after allowing the continuing resolution to go through. A question of who's going to take the helm in the next election cycle at a time when this is a very split party trying to figure out its way.
You see the senator talking about taxes on The View?
I did.
In the last week? Yeah. How not to connect with voters,
well,
101.
There needs to be some remedying.
Just totally out of touch. A career in politics. No idea what it's actually like to go out into the world and earn some money.
They got a couple of years.
It just doesn't work. Up next on the programme, the Cisco Chief Product Officer, Jeetu Patel. Do not miss this conversation. Up next. Let's check out the market. Equity futures right now in the S&P negative by 0.2%, looking to avoid 5 straight weeks of losses on the S&P 500, already on a 4-week losing streak, which is the longest going back to August of last year. For the Nasdaq, we are on course for a 5th, which would make it the longest losing streak going back to 2022. The Nasdaq this morning down by 1/3 of 1%. Let's get you some morning movers. Let's cross over to Yahara Hackers. Hey, Yahara.
Hi, John. We start with shares of Nike down more than 6% after the company gave a forecast far worse than what analysts were expecting. They said sales will decline in the current quarter, and they expect gross margin to fall sharply. It's owing the weakness to tariffs, the consumer, and simply the impacts of a new CEO trying to turn the company around by clearing inventory to make way for new products. But it's just a tough environment to be doing that. Next up, we have shares of FedEx also falling 7.4% after cutting its full-year outlook for the third straight quarter. They're calling this a very challenging operating environment due to the usual suspects, tariffs, the consumer, but it also says inflation is going to hit the bottom line. So just the latest U.S. corporate warning us about the economy. And last up, I managed to find a riser for you, and that is Lockheed Martin. It's up more than 2% on this news that it's in the running to win a government contract to build the next generation U.S. fighter jet. That announcement by Trump and Secretary Hegseth is expected to come today. And according to our reporting, they will choose either Lockheed or Boeing. The market thinks it's Lockheed. John?
Yahara, thank you. That speaks to the moment we're in, doesn't it?
That the one stock that's
the
up
one you
is
can find.
A defense one that has to do with fighter jets. Welcome to 2025.
Seen a similar story over in Europe as well. On our radar this morning, let's get you some top stories. President Donald Trump denying a report that Elon Musk would be briefed about U.S. contingency plans for a war with China. The New York Times reporting Musk would be briefed by Defense Secretary Pete Hegseth and other top officials. Elsewhere, President Trump invoking emergency wartime powers to boost U.S. production of critical minerals. Trump signing an executive order directing the Defense Department to provide financial and investment support for mineral production projects. And finally, a top story worldwide. London's Heathrow Airport coming to a standstill after a nearby fire caused a major power outage. The travel hub now closed for the day, with more disruptions expected through the weekend. Joining us now on the ground at London Heathrow, Bloomberg's Guy Johnson. Guy, we had this conversation now for several hours. Have we got some more clarity, any details whatsoever as to how this happened?
Absolutely none, John. There was a fire. It happened just after midnight. The fire brigade were called. They put it out at just after 6:30. The airport's going to be closed all day. It is absolute chaos. We've got normally kind of 1,300 flights coming in and out of here on a daily basis. You've also got a lot of incoming flights that were inbound. They've been diverted. There's no indication as to when this is going to reopen. We're being told it's going to be midnight is the kind of the next deadline. But basically, the power could be restored before then. But even then, the airport probably won't close. John, it just speaks to the problem that the UK has right now with just a lack of investment into critical infrastructure. This is a key piece of kit for the UK. It is unbelievable that we find ourselves in a situation that it cannot operate because a substation, an electrical substation a couple of miles north has taken the power out the entire region. It's absolutely amazing that we find ourselves in this situation. At the moment, the government is saying there's no indication of foul play. So that means basically just a piece of kit has failed here, which is unbelievably embarrassing, you could argue, for the UK and the state of its infrastructure.
And I'm sure people will be talking about that for a long time, Guy, going through this and trying to figure out how to prevent it from happening again. In the meantime, there are a lot of people just wondering, can I fly to London? Can I fly to New York? Where am I going to go? Where are the planes right now getting diverted? Is there some sort of effort to divert that traffic, or are they just getting canceled?
Lisa, most of them are just getting cancelled, to be honest. You can't get into the terminals. There's 5 terminals here. You can't get into any of them. Terminal 5, the kind of the BA terminal, operates on a different power grid. The lights are kind of on there at least, but you can't get into any of the terminals. The police will not allow you access into this area, so nobody can even get to the airport. That's kind of the early indications as to where we are right now. The flights that were inbound, they've been diverted all over the place. Some of them have come into the UK, some of them have gone to Gatwick, some of them have gone to other airports in the UK, some of them have gone to Shannon in Ireland. So Ryanair, for instance, is putting on extra flights out of Ireland into the UK, so people that are landing in Shannon can probably get in to the UK. But yeah, most people, I think, to be honest, people are being told not to come here. To be honest, I don't think you're going to see Heathrow's full service being restored probably until early on next week. There are going to be cancellations over the next few days. It is going to continue for a while. Crews are out of position, aircraft are out of position, passengers are out of position. This is the busiest airport in Europe that's got a 24-hour outage. The ripple effect of that is going to be absolutely massive. So yeah, no, you can't travel from Heathrow. Getting in and out of the UK today is really difficult.
4th busiest on the planet. Guy, appreciate the update. Guy Johnson on the ground at London Heathrow. I'm not a Gatwick kind of guy. Not a fan of that airport at all. You've lived there, you know it.
No,
Yeah,
I'm not a fan of Gatwick, that's why I left, or Stansted. But City Airport's very convenient.
Very convenient.
I'm sorry, but beggars can't be choosers
right now. I'm just trying to get it.
I mean, go for it.
I'm with you.
You got Gatwick, hallelujah, congratulations.
Totally with you.
It's a schlep. It is so far to get to. There's not as many nice stores. I mean, Heathrow is cream of the crop.
First world problems. OK, let's turn to tech. NVIDIA and Cisco announcing plans this week to extend their partnership, creating their most advanced AI architecture package that will provide secure enterprise AI networking. I'm very pleased to say the Cisco Chief Product Officer and Executive Vice President Jeetu Patel joins us now for more. Jeetu, it's good to see you, sir.
John, it's great to see you. Thank you for having me.
Thank you for being here. I've wanted to do this for a while with you. We all have. Let's just take a giant step back before we get into this partnership. You know what I worry about? I worry that AI will do to services what manufacturing was done to by globalization. What is the risk of that happening over the next several decades?
Look, at any replatforming that happens, you'll always have some level of displacement of jobs, and we need to make sure that we make it as painless for society to make that transition happen. But I worry less about AI taking my job. I worry more about someone who uses AI really well taking my job. But if you take a step back, it's actually really exciting to see what the possibilities are with AI, because what people, even despite all the hype, what people grossly underestimate is the original insights that AI is going to be able to go derive that don't exist in the human corpus of knowledge that allow us to solve problems that we have not been able to solve until now. And so, whether it be in healthcare or financial services or transportation or whatever industry you pick, you will actually have a reimagination of the ways in which we can solve problems that have not existed up until now. And that's exciting, frankly, because you'll have this, population of 8 billion people that'll feel like it's got the throughput capacity of 80 billion.
Are we seeing that happen right now? Is that a dream for the future or something that's being realized in this very moment?
You're going to start seeing it happen in 2025. For example, there'll be, a meaningful amount of code that'll actually start getting autonomously written. And so you'll actually start to see so many more, the capacity of engineers will actually 10x during the course of 2025. It's exciting to see.
This, as you know, is the societal issue that I'd be slightly concerned about. So there are a bunch of graduates who are graduating over the next couple of years or so, and they went to learn to code because they were told this is what you need to go and learn to do. And they're coming out into a workforce where maybe they feel like they're no longer needed. What's the advice you'd give to them as they graduate?
Here's the thing that I feel like people, you might overestimate the capabilities on that front, because AI is still not going to have the human instinct and the judgment that you're going to need to have. You're still going to need to do oversight. There's a human in the loop, but now that developer is going to have a companion that can actually do the stuff that they didn't really care to do or they weren't as good at doing. So this is a net positive in my mind, and you're going to see a lot of progress in society because of it, rather than a regression that happens.
Not to build on negativity, because I actually am a very big believer on the positivity, and I'm excited for it. But there is this question of who's going to lose their jobs in the meantime. And John alluded to this idea that it's more of a white-collar issue than a blue-collar issue. And I'm thinking of things that we've heard about, like at banks, where there have been fat fingers that cause transfers or whatever else, and that some of those efforts are being shifted to AI. How significant do you think that transition is going to be?
You will always have some degree of jobs that'll get displaced, and then there'll be new jobs that actually get created. And the thing that we have to keep in mind is there's a lot of jobs that right now people don't have enough labor to get done, that we just don't have the resources to do, that actually don't happen right now. And so what AI will allow us to do is not just go do things that humans don't do as well, not just do things that replace humans, but actually do things that humans don't have the time to get done.
Which industries do you think are being the most aggressive about adapting to different AI tools and bringing them into their infrastructure?
I think across the board you're seeing it right now. In fact, I'd say, 2 years ago when ChatGPT came out, almost every company in every industry went on noticing what's our AI strategy going to look like. And we've now had a couple of years to go bake that. And in 2025, you're going to see this really exciting move from just chatbots to agents, where you'll actually have workflows get automated in every industry, in every sector, in every segment of the market, in every geography. So I feel like there's only going to be two kinds of companies in the world, those that are going to be really dexterous with the use of AI and others that are going to really struggle for relevance.
Before we talk about facilitating that for corporate America, Jeetu, can we talk about how things are changing inside Cisco? Yeah. What's different about how Cisco's operating with these advancements that you're talking about?
We are lucky in the sense that we've actually got a front row seat on what's happening. And, everything from the way in which we're building out infrastructure to the way in which we're getting our security and safety parameters in the right way, and then making sure that the workflows get automated. So, how are we using AI in engineering? How are we using AI in our contact center so that when customers call because they've got a problem, we're using AI to make sure that we can help them solve the problems faster? What are we doing in legal? What are we doing in marketing? What are we doing in sales? Each one of these areas is getting rethought and reimagined. It's actually exciting to see.
The whole world's got to do this.
Yes,
the whole of corporate
every
America's
company.
got to do the same thing.
Every company, every government.
That introduces this partnership with NVIDIA. Talk to us about that and what's going to change over the next several years with that partnership in mind.
So we're excited. Jensen, the CEO of NVIDIA, put it best. He said Cisco and NVIDIA are putting together the blueprint for securing AI. And look, John, I go talk to a lot of customers all the time, and when you go ask customers how enthusiastic they are about AI, virtually every CEO, we had a study we recently did, 97% of the CEOs said they were excited about AI, but only 1.7% felt prepared, right? And so there's this kind of dissonance between the preparedness and the level of enthusiasm that's there. And then you ask in the next level question, why do you not feel prepared? There's two reasons that come up. The first one is they don't feel like they've got the right infrastructure in place to make sure that they'll be able to harness the full potential of AI. And the second one is safety and security actually holds them back because they feel like it also is going to have a negative effect on adoption, because if you don't trust the system, you're not going to use it, right? And so those are two areas where Cisco helps customers out. And what we've done with NVIDIA is we just announced a partnership for this thing called the Secure AI Factory. Now, what is an AI factory? An AI factory essentially is a data center that's meticulously built for AI workloads. And what it allows you to do is make sure that you can create these data centers in the enterprise that can allow organizations to fully harness the potential of AI. And so we're jointly partnering over there. It'll be our networking, our security, their technologies. Look, Cisco is one of the greatest networking companies in the world. NVIDIA is a pioneer on the chips and actually created, to some degree, the movement in AI and the combination of the two companies together. And I think you're going to see more and more of this, where companies are going to partner with each other in this ecosystem to really go serve needs of customers and work backwards, even if there might be a slight competitive element.
This is fascinating to me because what it signifies is there's a growing number of companies that don't want to rely on the hyperscalers, that don't want to rely on the cloud systems to provide the artificial intelligence for their businesses. And it raises a question about the model that everyone has bought into in the market, which is that they will be the big beneficiaries. How much is that changing with companies not wanting to necessarily develop their artificial intelligence in the cloud for security reasons and want to have it in secure locations that keeps their data encapsulated?
I think you're going to have both. I think there's going to be probably the fastest growth that hyperscalers experience that they've ever experienced with AI, and there'll be the fastest growth that enterprises have, because there will be some data centers that they'll want to repatriate back within the enterprise so that they can make sure that, and especially in areas like inference, you'll actually see a lot more of that. There's two big areas. There's training infrastructure that's needed to train the models, and then there's inferencing, which is what happens when you use the models. And on the inferencing side, you're seeing a fair amount of repatriation of data centers back in enterprise. And I think you're going to see a little bit of both. And we want to make sure that whether you're a hyperscaler, you're a service provider, you're an enterprise, Cisco wants to serve each one of them in a way that they can actually have infrastructure be plug and play. And it's massively simplified. It's still too complicated.
What's the role of government in this? There's tremendous competition around the world. Obviously, I'm thinking of Washington and Beijing. Do you like what you're hearing out of the administration?
I'm actually very optimistic about the kind of things that you're seeing across the board with the enthusiasm on AI. If we weren't talking about AI, I would be concerned. But right now, the governments are talking about it. They're talking about how automation happens within the government, how automation is happening in the private sector, how they're going to make sure that they can accelerate the innovation on those areas. So I think it's net positive.
Are we going to be replaced? So we care about.
No, John, you'll still be here. And 5 years from now, I'm still going to come and talk to you at this show. And it's not going to be an AI humanoid. It's going to be John.
That's all I wanted to know. That's all I care about.
How do you know I haven't already been replaced?
That would be incredibly worrying.
Sorry, carry on.
We had a guest recently who was remote, and I worried it might be AI. just didn't have a clue. You never know. You never know. You never know. Jeetu,
I'm going to make you an optimist someday. This is going to be a fun world that we live in.
You're slowly converting me. I'm looking forward to being on this journey with you. Jeetu, you're one of the best. Appreciate it. Thanks for being here, sir. Thank you. Jeetu Patel there, the Cisco Chief Product Officer and Executive Vice President. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Defense Secretary Pete Hegseth said he's canceling more than $580 million in Pentagon grants and contracts deemed wasteful spending. In a memo, Hegseth said the programs don't align with President Donald Trump's priorities. Meanwhile, AstraZeneca is investing $2.5 billion in a new research center in Beijing that will include an artificial intelligence lab. The expansion comes as Chinese authorities are investigating current and former AstraZeneca employees. The drug maker's China president was detained last year as part of the probe. Shares are lower 1%. Meanwhile, shares of Micron are lower, down 3.4% after the largest U.S. maker of computer memory chips gave a soft margin outlook. That's seeming to offset what was a strong sales forecast for the current quarter, bolstered by demand for artificial intelligence products. Micron shares are up more than 22% so far this year. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, rising growth fears.
This just makes the growth backdrop all the more critical because the Fed is telling you that inflation will not allow them to be responsive. You have to be invested for a wide range of growth, inflation, and policy outcomes.
That conversation just around the corner with Greg Peters of PGIM Fixed Income. He joins us next, live from New York. This is Bloomberg. Equities are a little bit softer here. We're down by 0.25% on the S&P. On the Nasdaq 100, down by a third. Isn't Jeetu Patel at Cisco great?
Oh, that was so much fun.
Fantastic.
You're all Debbie Downer. I love this.
He's slowly converting me.
Good, I'm glad.
Slowly converting me.
I mean, scary. I'm optimistic. I think that it'll be great when we can have a more efficient life. And frankly, that's the reason why I am now a bot and I'm not actually real.
Some people might believe that, Lisa. Under surveillance this morning. I'm joking. Rising growth fears.
This just makes the growth backdrop all the more critical because the Fed is telling you that inflation will not allow them to be responsive. The question is how much of a growth deterioration needs to occur before the Fed can react, and it seems to be that the bar is pretty high. You have to be invested for a wide range of growth, inflation, and policy outcomes.
So here's the latest this morning. The Fed cutting U.S. economic growth expectations amid rising uncertainty. FedEx and Nike joining corporates issuing new warnings. Greg Peters of PGIM Fixed Income writing, our base case is still broadly constructive, but our view of the balance of risk is more bearish than the market. U.S. spreads are starting to price in higher recession risk. Greg joins us now for more. Greg, welcome to the program, sir. I just want to sort of back up and go back a few months because it's been a while since we really got some detail about where you were seeing things going and what you expected. Did you expect this repricing that we have seen over the past month?
Yes and no is the answer. We were pretty constructive going into the year, felt growth was in a very good place. We were talking about and worrying about what we called this sequencing problem from a market standpoint, where all the bad policies are up front from immigration and tariffs, and then the better policies are down the road. And so we felt we'd be in this vacuum period in the first quarter or first half, and that's what we're getting. What we didn't anticipate nearly enough was a disruption in the process. And the question on the table is how much of that disruption will hurt growth in ways that we didn't, initially forecast.
Greg, you've been bullish, though, on bonds, in even long-term bonds for quite a while. The other aspect that we didn't anticipate was a German fiscal package that could amount to some trillion euros over the next 10 years. How much does that change your outlook for longer-term benchmark yields globally, but also in the United States?
It does change it on the margin, absolutely. There is a natural bias. Domestics want to invest in their, home country, so to speak. If you look at the flows, the flow from Europe into the U.S. bond market has been pretty pronounced. I expect that to slow. That's why the bond market did react to the kind of the QT tapering or slowdown, from Tuesday or Wednesday. But yeah, I mean, what we're seeing is that there's less and less buyers of U.S. Treasuries, right? There's a tremendous reliance on kind of this hedge basis trade, and foreign investors have, stepped away in a pretty meaningful way. So it's something to watch out for. And all else equal, Lisa, it puts pressure on bond yield and steepens out the curve.
This creates a real question and conundrum, frankly, for a lot of credit investors who came into the year. Some people argued price to perfection with this belief that we would have a fantastic economic backdrop with growth, with also disinflation as an ongoing backdrop. How much has that shifted? The idea that on one hand, disinflation has its limits, along with the fiscal impulse elsewhere, plus the idea that maybe the economy isn't going to be as good.
Well, we are credit investors, and at the end of the day, being so is exactly where we want to be. So the question is, do we avert a recession? I think we do, but the risks have definitely increased, and that's a very good backdrop for credit. So credit investors want this, plodding along where businesses are maybe a little more concerned. They're not spending, the way that equity investors would ordinarily like, and so we're potentially here in a very good place for credit, but the risks are just so high, the uncertainty so high, it really makes it a challenge. But go back to your original statement, Lisa. Risk reward entering this year was absolutely horrific. We were in the top decile of valuations, and so it just really wasn't a good environment from that standpoint. So it's not about the macro so much from the credit side, it's about the valuations. And valuations are still pretty stretched in my view.
Yeah, Greg, I can't think of a single time, in recent memory at least, where sentiment seems to have collapsed as much as it has, yet the price of assets haven't. If you look at the index on the S&P, we had a 10% correction, but if you listen to the way people talked about it, it felt like we were down 20, 25% on the S&P. Similar story with credit. The way people talked about the economy, you'd think credit spreads were 200 basis points wider in just a couple of months, and that's certainly not the case at all. Greg, how do you reconcile those two issues?
Because I think broadly the macro's in a pretty good spot, and that's what investors are focused on. It has been a surprise. The delta from an expectation standpoint has, I think, been the big change. But at the end of the day, the fundamentals are actually reasonably pretty good. And so it makes sense to me that you didn't see this massive repricing, marginal repricing, because what's changed are the tails, right? The tail risk has increased. The modal outcome might be, virtually unchanged, but the tail risk, and that has to manifest itself in the pricing. That's not a wholesale resetting of pricing. That is a marginal reset of pricing.
Greg, appreciate the framework to think about this. Thank you, sir. As always, Greg Peters there of PGIM Fixed Income. We've had a meltdown in sentiment. Not in the market. At some stock level, I know some single names have had a really tough time, but at the index level, not much of one at all.
I love Greg's point that credit investors like it when people aren't too happy, because that means that they're going to be a little more conservative, which means you'll probably get paid back.
Moody bond investors.
I mean,
seems to be a thing. I know.
I get it.
It resonates.
It totally does.
I know. Kate Moore of Citi Wealth joins us in just a moment. Patrick Moorhead of Moor Insights and Strategy. David Mericle of Goldman Sachs, and Vishy Tirupattur of Morgan Stanley. This is Bloomberg.
Everyone has a view about what the Fed should do.
You're going to need to see some weakening of the hard data beyond what we've seen so far to get the Fed really moving.
Policymakers have to pin down a forecast and think about what the future might look like.
I do think that the economic data will justify a cut by May. As long as they're talking about it at the May meeting, that should ease financial conditions.
What actually is quite clear is they just don't know, and none of us actually know exactly what's going to happen. They're in a really tough spot at the moment.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The opening bell 90 minutes away. The third hour of Bloomberg Surveillance starts right now, with equity futures negative by about a third of 1% on the S&P 500 through Thursday. Just about positive on the week so far, following 4 weeks of losses. On the Nasdaq, though, we are poised for a fifth consecutive week of losses on the Nasdaq 100, and we add to them this morning. We're down by 0.4%. A couple of single names to look for this morning. Nike's one, FedEx is the other. FedEx It is so difficult for this company to have any visibility whatsoever. They just keep cutting guidance, and they've done it for 3 consecutive quarters.
And one of the fundamental reasons why is the business-to-business aspect of FedEx is really a big question mark right now. Not only is the international picture with tariffs, et cetera, but the capacity for companies to be able to spend in some sort of substantial way is just not clear. They're sort of the epicenter, the example of the lack of clarity around the corporate sphere around the world right now.
They're also lifeblood of the economy when it comes to logistics. When you think of things like tariffs, like de minimis, and potentially the provisions around that, and if that might end up sapping some of the demand for some of these smaller packages, it's very difficult right now. What we continuously see from company and company, a litany of them talking about they just cannot plan for the future.
We're getting so many conflicting reports from the economic data, soft versus hard from corporate America. Chairman Powell sees it this way. We do understand that sentiment has fallen off pretty sharply, but economic activity hasn't yet. Goes on to say, I would tell people the economy seems to be pretty healthy. That's where Chairman Powell is at. That's the Fed chair. This is where the president's at. The president's in a very different place. He believes they should just start cutting interest rates, and he keeps pushing this point day after day.
He's a real estate developer. What do you expect him to say? I mean, essentially, that is just the bottom line. It is a little bit of a different tone, just because initially we were thinking that this administration was more focused on the 10-year yields, and Scott Bessent certainly is. A large question of whether this is trying to get ahead of what they're about to announce on April 2nd, given the fact that it could potentially be something of a shock, along with a lot of people talking about price pressures ongoing.
If you're going to have higher prices, even if it's a one-time price hike, potentially where can you offer some relief elsewhere? The president's saying that because gasoline is down, which is going to be fickle, and because eggs are down, which they're only down wholesale, not what consumers are seeing at the grocery store, that is reason enough for the Fed to cut rates. Jay Powell doesn't see it that way.
So that's the latest on the Federal Reserve. We'll have plenty of chat on that through the hour. I imagine some of you are joining us this morning to get an update on what's happening over at London Heathrow. We'll catch up with Guy Johnson later on this hour. London Heathrow is closed all day due to a power outage caused by a fire at a nearby electrical substation. What caused that fire, we don't know. The Met Police putting out some headlines this morning saying there's currently no indication of foul play in the fire. They're working with the London Fire Brigade to establish the cause of it. But ultimately, we haven't got any details on how this happened.
Let alone when it's going to be resolved and when we're going to have a reopening of Heathrow. Guy Johnson just on less than an hour ago saying that it's likely not going to be fully operational until at least early next week. That is a lot of flights for the 4th busiest airport in the world.
This is what the airport had to say this morning. Passengers should not travel to the airport under any circumstances. What a mess this is going to be.
Yeah, the lights aren't even on in certain places. This is a problem right now for such a busy airport, and it raises questions about disruptions. It also raises questions for the airlines that already have flagged concerns about consumer demand at a time where there is this level of uncertainty. How do you deal with a week of canceled flights, given the fact that this is one of the busiest corridors that we have?
As Guy said, it's just not a good look for the public relations team over at the United Kingdom, is it?
It's not a good look is an understatement.
London Heathrow's like jewel in the crown kind of stuff. It's not a good look at all.
Especially if you think about their need to rebuild infrastructure and their lack of borrowing capacity, given some of the constraint on the budget.
It's a major hub, 200,000 people, 1,400 flights, and the fact that they can't actually give you guidance on when they may reopen, I think that's going to be the biggest problem.
Brutal, and brutal for many of you, I know. We'll try and get you some updates through the hour right here on Bloomberg TV. Equity futures on the S&P, negative by 0.2%. The opening bell just around the corner. Coming up on the programme, Kate Moor of Citi Wealth on why it's too soon to add risk. Patrick Moorhead of Moor Insights and Strategy on a wild week for the Mag 7. And Vishy Tirupattur of Morgan Stanley on why he lowered his growth forecast. We begin this hour with stocks lower. Kate Moor of Citi Wealth writing sentiment has weakened but not fully collapsed. And absent full capitulation and with persistently high uncertainty around tariffs, growth and policy, we believe it is too soon to step in. Kate joins us now for more. Kate, good morning. Good to see you.
Yeah, thanks, John.
Congratulations on the new seat as well. It's
Thank
the first
you.
time we've seen you since you moved over.
I had a nice break, and I've been getting ramped up at Citi. You know, it sort of pains me to have to write what I just wrote and what you read. You know me, I like risk. I've always liked to look at opportunities. I like to see when there are dislocations and say this is a nice time to step in. And right now, to the conversation you guys were just having around uncertainty, not just in terms of the macro forecast, but also in earnings, it's almost impossible for me to say, we've seen the bottom, we can break out of this trading range, and it's time for us to add.
There's always a price. Have we reset price low enough? How much more do we need to do that? Have we reset expectations sufficiently? what would you look for that would change your mind, that a risk reward would become more compelling?
Well, one of the things that I keep getting my head stuck on is everyone's focus on PEs, right? On multiples and valuation. And they keep on saying over and over again, you know, we've derated a little bit. It's now looking a little bit more attractive. And I say, that's great. We have no faith and confidence in the denominator. And against that backdrop, if you don't know what you're measuring yourself against, like, are we cheap? I don't think so. Look, there are super high quality companies in the U.S. I know we've had some rotation away from those companies over the last couple of weeks of trading. But, you know, that doesn't mean we need to step in and kind of back up the truck and add back to those companies right now. And I hate, as I said, sitting on my hands a little bit because, like everyone else in this business, I have a bias to action.
How inconsistent are some of the projections that we're getting right now out of Wall Street?
Oh my gosh.
Well, on one hand, you've got, I know, it's a big question. You want to just start there?
Yeah, no, this is, I mean, it's a terrible time to have to put out forecasts. I'm fortunate enough to not have to put a target on the S&P or say, here's my technical buying level or here's my earnings expectation at the moment, because it is going to be a losing game at this moment. We could get to April 2nd and have some clarity. I would put a much higher probability that we don't have clarity after April 2nd. And so people are going to have to make these constant revisions. And especially, as we were talking about before, corporates don't know what's going to happen. One of the things I'm worried about and / watching as we go into this next earnings season is not just whether or not companies take down their guidance, but whether or not they pull guidance altogether. If they say we don't have enough information to even reaffirm or adjust or even take down what we've given you before, we're going to step back. That tells us that kind of all bets are off and kind of continuing to sit on the sidelines makes some sense. Now, to be fair, for like Citi Wealth clients who have, you know, multi-asset portfolios, we're not saying sell. But, you know, there are a lot of folks that have big cash balances, and we want to be convicted when we say put that cash to work.
That was what I was just going to ask. What does sitting on your hands actually mean in financial terms? Does it just mean sitting on cash? Does it mean sitting on gold, going to London?
It's not making big asset allocation decisions right now. Let's wait for more information. And whether that's, you know, tweaking our equity allocations or looking for more opportunities across the fixed income or alternative space, like, we don't need to do that right now. Let's wait for, hopefully, what will be a little bit more clarity.
Do you think you're going to have the conviction after April 2nd to make some of those decisions?
I think April 2nd is an arbitrary date. I mean, it is a point at which we will have some information on tariffs, but we won't have a significant outlook for the entire policy program in the U.S. And until we have that, it's pretty hard to say, you know, what the growth forecast should look like. This is what I would also say. We have a pattern of behavior from this administration over the last couple weeks or a couple months that suggests there's, you know, a constant revisiting of their own targets and what pain they're willing to take, even as they stay focused on what they believe their big goals are. And the communication has not always been consistent to the corporate sector and to the investment community. And I don't know that that changes just because we get to April 3rd.
One thing is consistent. The president this morning, just minutes ago, saying April 2nd is Liberation Day in America. But to your point, to a lot of people's point, they're not expecting April 2nd to be the end all, the be all. If uncertainty is a feature, not a bug, how do you do this for 4 years?
I think you're going to have to stay really focused on the areas where you do have certainty. You know, I always have a bit of a laugh when everyone says we want to own quality companies. No kidding. There's no point in the cycle where you don't want to own a quality company. And like any fund manager or investor says, like, I don't care about quality. I mean, I think you should probably head for the door. But what we're looking for, I think, in an environment where there is a lot of uncertainty is earnings sustainability and earnings stability, basically, in general. We want companies that can earn through all parts of the economic cycle, that have strong products and business models and, like, really, like, outstanding management teams that we can have faith in. When it comes to fixed income, we're going to have to see what happens to the inflation and growth side. So I can't say for sure what that kind of uncertainty will mean for that allocation.
The new policies are confusing. The administration, they seem to change every day, and they can change again very soon. And they will do on April 2nd and maybe again multiple times after that as well. That's hard enough. Understanding how the rest of the world responds to it is equally as complex. How much has Europe's response to this complicated how we allocate assets in the United States?
Look, I know people have gotten really excited about, you know, closing their underweights. I'm not going to say going explicitly long Europe, closing their underweights to Europe. And they've said, look, there's some of these pockets of fiscal stimulus, something we haven't gotten in a long time, and they've gotten really excited. I don't think that we can say we're going to make a wholesale regional equity change based on a few policy announcements. And unfortunately, and I hate saying this, but I'm going to say it anyway, when the U.S. sneezes, the rest of the world catches a cold. If there's a significant slowdown in demand and activity on both consumers and businesses in the U.S., it's really hard for me to imagine that all these global multinationals domiciled in all these other markets won't feel it and that consumption patterns won't change.
So you don't buy into the erosion of U.S. exceptionalism?
I think the U.S. has some really exceptional parts of our economy and our corporate sector, but we are at a more challenging part of the cycle. The other thing I would say is, even going into this policy uncertainty, you guys know this very well, some of the macro data was slowing a little bit before any of this uncertainty was introduced. There were some pockets of retail and consumer. We were talking about that a year ago, remember? As we were going through first quarter earnings for 2024. Everyone was saying, is the consumer cracking? It didn't fully crack. But as we got into the beginning part of this year, some of those fractures look more pronounced. So that happened before the policy uncertainty. And I think we have to keep a very close eye on that.
This speaks to the wait-and-see moment that so many people are in right now, not just businesses, but investors too.
I just want to know what's going to end that, right? If it's not April 2nd, if it's not necessarily guidance that companies can't give, what's going to give anyone a sense of conviction at a time of endless uncertainty?
Yeah, I wish I knew right now. And if I had the roadmap and my crystal ball was crystal clear, that would make me sleep a little bit better at night at this moment. But I will say here we are on a Friday morning, and we know a lot of investors, both fast money and real money, don't really want to go into the close today or into a weekend, super long risk, because of the uncertainty factor. I want to see a change in that overall behavior. Once we start to really neutralize some of the big overweights and sometimes underweights that people have had in their portfolios over the last couple of years, and people feel confident that what they're owning and what they're adding to can perform in a sustained way over multiple quarters, I'll sleep a lot better. I just don't think we're there yet.
Kate, it's good to see you.
Yeah, thanks for having me.
Happy to catch up. It's been too long.
Yes.
Hopefully we can do this more often. Kate Moore there of Citi Wealth. Kate, thank you. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here is Yahara Hacker. So, Yahara.
Hi, John. London's Metropolitan Police says it sees no current indication of foul play in the fire that shut down Heathrow Airport. It says it's working with the London Fire Brigade to establish the cause of the fire, which happened at a nearby electrical substation. The closure brought travel to a standstill for hundreds of thousands of people. Meanwhile, a Maryland federal judge has temporarily blocked Elon Musk's Doge team from accessing Social Security records. For now, it stops Doge from seeing the personal information of potentially hundreds of millions of Americans who receive Social Security retirement pay and other benefits. Musk has called the program a Ponzi scheme. And investors are dismissing the risks a full-on trade war would pose to stocks. That's according to Bank of America's Michael Hartnett. In a new note, he cites, quote, monster flows of capital that keep pouring into global equity markets despite all of the recent tariff announcements. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next on the programme, the morning calls, plus Patrick Moorhead on a wild week for big tech. That conversation just around the corner. Live from New York City this morning. Good morning. When were you two this excited for a weekend? What's going on here?
Trump world. Come on. Rest. You're not?
No, I love doing this.
Okay, but
I do.
Let's get you to the weekend. Look, we all love doing this.
Every single minute means so much to me.
I understand that.
Wish it away, Bramo. It's got to get through the rest of the hour.
Really?
Yeah, it's important stuff.
Thanks for throwing me under the bus.
Equities down a whole quarter of 1% on the S&P. On the Nasdaq 100 down by a third. The opening bell 1 hour and 13 minutes away. Let's get you some morning calls. First up, JP Morgan cutting its price target on FedEx to 280, highlighting its weak outlook. That stock is getting hammered in the pre-market. It's down by 9%. Your second call from UBS lowering its price target on Nike to 66, expecting the trade war to continue, weighing on profitability. Their stock is lower by more than 7%. And finally, Morgan Stanley trimming its price target on Tesla to 410, pointing to weak auto deliveries and negative investor sentiment. You can say that again. What an ugly month for that stock.
And it's gotten so ugly that Elon Musk is even responding to it with talking to some of the people in the company and saying, guys, it looks really bad. But believe me, we can get through this.
It's gotten so ugly that the Commerce Secretary, who used to run Cantor Fitzgerald, went on Fox News and said you should buy this stock, which I have to say is raising a lot of concern in Washington about whether or not that is not just appropriate but legal.
Yeah, that's new. Something we haven't seen before, isn't it?
Well, you know,
cabinet officials.
Old habits die hard, you know. Look, it's not just cabinet officials. This has been sort of increasingly by government officials being made into rally around the stock. There's nothing wrong with it, which only makes it more political. I mean, it really raises this issue for Tesla that shows the sort of liability of how closely they're associated with this administration.
Got to get a price target next time. Let's get to Mag 7. The stocks are down nearly 15% so far this year, led by double-digit declines from Tesla, Apple and Alphabet. Nvidia's AI conference failing to give the group an extra boost. Patrick Moorhead of Moor Insights joins us now for more. Patrick, welcome to the programme, sir. The Mag 7, just in terms of a concept, a term, just how useful is that anymore?
Well, I think it's useful as a barometer for the biggest in tech. And it varies. It changes, right? We used to have FANG, and now we have the Mag 7. I think it could change if some companies nosedive, new growing companies come in there. I think we'll find another acronym for that. But I think overall, it's a pretty good bellwether for how big tech is doing.
Why is big tech doing so badly? And I ask this because they haven't posted terrible returns. There still is AI adoption. We were just talking to Jeetu Patel of Cisco about how this still is the holy grail for companies and is rapidly in expansionary territory. I don't understand if this is a valuation thing, if this is an American exceptionalism story, or if there are some other issues here under the hood.
Yeah, so there's 2 or 3 things going on. So at macro, I think Kate did a good job in your previous segment talking about risk, right? How do you play this? Recession, consumer confidence, interest rates, tariffs. And if you listen to the forecast for the earnings calls of some of these tech companies, there was a lot of uncertainty. I think that's bleeding over. And then you have this general fear, which is related to consumption, which is, hey, all this CapEx investment, somebody has to consume that at the end. Companies that serve consumers and companies that serve businesses have to make incremental profit dollars off of that. And I think that risk, that discussion is showing its ugly head here with the Mag 7 that, quite frankly, are being driven by really, good earnings, good cash flow. But in the end, it's this promise of mega growth delivered by the AI trade.
Well, it goes to the question that John really asked to start off the conversation, which is how much can you really talk about Magnificent Seven when there are a lot of distinct buckets and companies within that are dealing with different aspects of that. I think of Apple as being very much susceptible to some of the consumer pushback and some of the smartphone cycles. I think of Tesla as having a whole bunch of issues around that. With the likes of the cloud, with Google, with Amazon, with Microsoft, how much can they be more insulated from some of that volatility, since their issue is that they think people can't invest enough? And we're hearing that from a lot of companies themselves.
Well, those companies just listed off, they essentially make the foundation for AI. If you're going to do something useful downstream, if you're a consumer company or you're an enterprise SaaS company, they're investing the hundreds and billions of dollars in CapEx to be able to deliver that. I think the focus right now should be on those consumers of AI. The consumer plays, Apple was a great example. HP is another great example. How about Salesforce, right? We've seen ServiceNow racking up double-digit growth, but that's not necessarily all on the back of AI. How about SAP? Once we see those downstream companies being able to better leverage and monetize AI, I think a part of the risk scenario here, not the macro point, but this consumption conversation will be put to bed.
Patrick, how long before we get to that moment? You mentioned Apple. So Apple's had a difficult time of it, down by double digits for the year and, for that matter, for the month so far in March. What's going wrong for Apple and how quickly can they turn this story around?
Yeah, the challenge with Apple is twofold. So first of all, they really do not have any core competency in the cloud. And when it comes to the delivery of many of these experiences, it requires cloud competency, and Apple doesn't have it. The most sophisticated thing Apple does in the cloud is backup and streaming some video. And secondly, what I think is becoming a reality right now is that Apple didn't put enough resources on the smartphone to help them create relevant on-device AI experiences that keep your data private. And without getting too technical, they didn't put enough memory in there to run these workloads. And I think they're running into that. I think thirdly and finally, Apple knows that their future business is based on not messing up as opposed to innovating. And they're going to be super risk averse when it comes to any type of AI type of implementation. And as we've seen, right, we've played around with ChatGPT, Grok, et cetera. You can get results that might not be savory for the Apple brand, but we know it as consumers that AI isn't perfect. In fact, it's perfect in its perfection. Don't quite know what type of result you're going to get. And I think it's going to be a very tough road for Apple in the future because of these core competency issues in the cloud and under-speccing their devices.
That stock is down again this morning. It's down by about 1%. Patrick, appreciate your time, sir. Patrick Moorhead there of More Insights and Strategy. The latest reporting from Mark Gurman, just speaking to some of the confusion and the lack of progress on big issues over at Apple. This, according to people familiar with the situation, that Apple is undergoing a rare shake-up of its executive ranks, aiming to get its artificial intelligence efforts back on track after months of delays and stumbles.
This has been a huge issue for Apple and just speaks to maybe an ongoing delay as they try to ramp up new leadership in the unit. They have fallen behind on this. They've not gotten certain key deliveries. It's been beyond just simply conceptual, and it raises this issue of how do they get back on the front foot when they've got some real competition, particularly in China?
Stock is down on the session, down on the month and down on the year so far. Up next on the programme, we'll talk about the US economy, a recent downgrade to the outlook from Goldman Sachs. David Mericle is going to join us shortly, and then we'll get the bond market view from Vishy Tirupattur from Morgan Stanley, from New York City this morning. Good morning to you all. You're watching Bloomberg TV. Shots fired at baseball just moments ago. Should we go there?
I mean, it's just like, really? On a Friday?
Cheap imitation of cricket.
That's just unacceptable.
That did not come from me.
I know, but you really seem to empathize with it.
No, it made me laugh.
And want to
smile.
Put it up. Okay, John, why do you feel that way?
Made me smile.
Why do you feel that it's a cheap imitation of cricket?
Grew up with cricket. I don't understand the rules of baseball.
Okay, but it's the understanding issue.
I appreciate baseball.
Oh, good.
Don't understand the rules of baseball.
Like the Mets.
I appreciate some of the athleticism in baseball.
Okay.
Aaron Judge.
Yeah.
But when you see Aaron Judge in real life, it's like this giant, absolute beast.
The power to get the balls to go that fast really is amazing. And
I respect that.
I don't know that cricket has that.
No,
just kidding.
Our next guest might leave the studio.
All right, please say.
All right. Equities at the moment on the S&P down by 1/3 on the S&P 500. Softer, the opening about 60 minutes away. On the Nasdaq 100, we're down by 0.4%. President Trump pressing the Fed to cut interest rates, posting on Truth Social again last night that egg prices are way down, Groceries and gasoline are down. Now, if the Fed would do the right thing and lower interest rates, that would be great. David Mericle of Goldman Sachs writing, Powell reiterated the FOMC is well positioned to wait for further clarity. We have left unchanged our forecast for 2 cuts this year in June and December. David joins us now for more. David, welcome back to the programme. Since we last spoke, there was a downgraded cut to your GDP outlook. So let's build on that. What led you and the team to reduce your GDP forecast for the United States?
So we're 2 months into the administration, and we think that we've learned that the tariffs are likely to be larger than we had expected, say, between Election Day and Inauguration Day. We've bumped up our forecast for the eventual increase in the effective tariff rate from a 3 percentage point increase as of Inauguration Day to a 10 percentage point increase. There are a few signals that we've gotten from the administration, some of them subtle. For example, with the China tariffs, there's been none of the differentiation between consumer and non-consumer goods. The move ahead on at least small tariffs on Canada and Mexico, and a lot of signals pointing to an eventual critical imports tariff and a reciprocal tariff. And we think all of that's going to eventually add up to a larger increase. That means higher prices, and we think lower GDP growth this year, because the higher prices will function as a bigger hit to real disposable income and to consumer spending. The impact on financial conditions has been pretty tame so far, although if we do get larger tariffs, that could worsen. And we think that the uncertainty effects are much worse this time than they were in 2019, because far more American businesses are likely to be affected by tariffs that would really affect the whole world rather than just the U.S.-China bilateral trade relationship.
The uncertainty effects is exactly where I wanted to go, David. How much of your forecast and the downgrade to growth is coming from the tariffs themselves, and how much is coming from a prolonged period of uncertainty that's preventing certain companies from making any decisions at all, let alone investments?
I think the uncertainty effects do go beyond trade. The downgrade that we made to our forecast was really centered on the changes to our tariff assumptions. On other areas of policy, I would say there have been smaller surprises. We did also bring down our immigration assumption a little bit because we've seen a very sharp drop off there. Fewer people means fewer workers, and that means slightly lower GDP growth. But really, it's been concentrated on tariffs. I think what is different this time, at least if we do wind up getting the tariffs that we expect, is that last time this was mostly just between the U.S. and China. U.S. industry and Chinese industry don't overlap that much. U.S. manufacturers don't use that many Chinese inputs. They generally don't compete as much in the same output markets. And China's retaliation last time was pretty confined to agriculture. In contrast, if the administration goes ahead with a critical imports tariff and a reciprocal tariff, I think many American companies will find themselves affected on the input side, the output side, or from foreign retaliation from any of many countries. So the uncertainty effects, I think, have a broader impact on American business. I do think it extends beyond trade, for example, with some of the spending cuts. Even if the spending cuts don't wind up amounting to a huge amount, for the last couple of years, healthcare, education, and government have really dominated hiring in the U.S. And those areas of the economy, directly or indirectly, many healthcare providers, many state and local government agencies, many schools and universities depend at least a little bit on federal payments. And if all of a sudden they're worried about losing access to some of their funding and having to engage in cost cutting, I do worry a little bit that they'll hold back on hiring, not wanting to be in a position where they'd have to lay off even more people. So I would say the uncertainty effects are mostly, but not entirely, about trade.
When it comes to trade, though, how do you incorporate the retaliation we could see by other countries? And to your point, it's not just the U.S. and China. There's a bigger scope this time around.
Yeah, that's right. We generally assume pretty full retaliation from most other countries. That's what you see in past trade disputes. The U.S. and Canada, the U.S. and Europe have been involved in trade disputes for many, many decades. The standard procedure, even between friends, these trade conflicts, get pretty rough pretty quickly. Other countries will typically look to inflict political pain on the party that's imposing the tariffs. So they'll figure out what electoral districts are very close, what do those districts produce, and then they'll hit items produced in those districts with tariffs. I think maybe other countries will pause for a couple of weeks this time just to see how serious the White House is about the tariffs. We've seen some tariffs go on and then come off. But if they do stay in place for an extended period of time, I would expect, as has been the case historically, that other countries would retaliate pretty aggressively with retaliatory tariffs.
David, do you believe what the Fed put out there in terms of inflation maybe ticking up this year, but actually falling back down the following year and the years after that, even with some of the different trade regimes, given the fact that there's expected to be slower growth?
Yeah, we actually made very similar forecasts. I think the Fed basically went through the same thought process as we did this week, asking themselves what has changed since they last did these projections in December. Well, I'm sure relative to their expectations, as relative to ours, the big change is that it now looks like larger tariffs are coming. And so like us, they lowered their GDP growth forecast somewhat, and they increased their inflation forecast somewhat. We're now expecting core PCE inflation to peak at about 3% this year. They're now expecting it to peak at 2.8% this year. Like them, we also expect that these will probably be one-time price level effects. One thing that I think we've learned that would not have been obvious to me on Inauguration Day is that the public is extremely alert to tariff news and to price news. And you've seen that reflected in both business and consumer surveys, with the large jump in particular in Michigan inflation expectations. But you've seen it a little bit more broadly than that. I would have thought a couple of months ago that if the effect of tariffs is to push inflation up to 3%, well, we were at 2.8 a couple months ago. That doesn't seem like a huge deal. And I think what we've learned is that's not the full story. In much the same way that gasoline prices have outsized salience for household inflation expectations, so we're finding that people are paying a huge amount of attention to the tariffs. And if there are tariff-driven price increases, people are going to notice. It would still be my base case that this does not become contagious, that it is a one-time price level effect. But I think that's more of an open question than I would have thought 2 months ago.
David, do you think rising anxiety around unemployment, which we've seen in the survey data, do you think that will dampen the potential of second-round effects?
I think that's right. I think one key difference with 2022, the last time we all worried about high inflation expectations becoming contagious, 5 becoming the new 2, is that back then people really were experiencing very high, very broad-based inflation. And back then we had the tightest labor market in history. And households had a lot more money to spend than usual because of the fiscal transfers, less to spend it on than usual because of the pandemic. And so when companies started experimenting with raising prices, they found that they took a smaller hit on volumes than they might have expected. I don't think any of that is going to be true this time around. Today, we have a labor market that is back in a better balance. And I think companies would worry a lot more that if they try to opportunistically raise prices on the thought that other people are doing it, why shouldn't I, that they will take a bigger hit in terms of volumes. That's part of the reason that I don't expect that the inflation effects of the tariffs would meaningfully last beyond this year. The other reason is we think the tariffs would weaken the economy, and a weaker economy should, if anything, generate lower rather than high inflation. I think that's basically how the Fed thought about it back in 2019, if you look at the transcripts from their meetings back then. Yep. And that is basically what the market is pricing too.
Seems to be the base case right now. We've all got to stay open-minded, but that's certainly the consensus view. David, appreciate your time, sir. As always, David Mericle there of Goldman Sachs. How much feedback are you getting about cricket?
Okay, so I'm actually asking ChatGPT, which is better, cricket or baseball. I'm getting quite a bit of feedback.
Wow, what did ChatGPT say?
Well, it's struggling. I will say that the initial take, I tried asking a different way, was that there is no better between cricket and baseball, that it is subjective, etc. Nice punch, ChatGPT. Nice punch.
Vishy, you started this. Vishy Tirupattur of Morgan Stanley's with us. Vishy, someone wrote in and said it's difficult to get people to appreciate a game that can last 5 days and still end in a tie.
True.
That just shows that there's no one form of cricket, John. As you know, there's a 5-day version, there's a 1-day version, and there's a 3-hour
What's your preference? I'm a fan of Test cricket.
Right.
Still, that's my preference. Still.
And some of the best cricket games have been actually drawn without a result. That have been some of the best cricket games ever played. So that shows both strategy, technique, enormous physical prowess.
Enormous.
I feel like this was directed at Lisa.
Hold on a second.
I like how you turn.
I actually just have to say, I did look up what physical attributes are necessary, and it has to do with speed, agility, ball coordination.
Same like baseball.
Mental agility.
Brett Lee, if you watch Brett Lee, back in the day for Australia.
A ball coming at you at
150
kilometers per hour, and when you're fielding, you're not wearing gloves. You're fielding barehanded.
This kind of feels like the moment we're in the market.
Oh, nice. Nice.
I appreciate that.
Feels like Brett Lee's pitching.
Yeah,
right?
Exactly.
Yeah, as if you know what that means.
Exactly.
But please
I have no clue what you're talking about, but I'll nod and agree anyway. There is a sense that we're kind of standing here trying to catch 150 miles per hour balls or wickets or whatever, snitches. What are they called?
Snitches, not Hogwarts.
What do you think this is, Quidditch?
Let's start again. Where are we? What do you agree with? How are you dealing with the uncertainty at a time when markets really are dealing with just a lack of understanding of what the parameters are, whether we actually are in an inflationary or disinflationary moment?
I think we are at an unprecedented level of uncertainty. There is enormous policy uncertainty. I think one of your guests earlier was saying something about whether this amount of uncertainty is not the bug of this where we are in the cycle. It is the feature of the cycle, and we just have to learn to live with it. So, for example, a lot of consternation about what happens on April 2nd. Indeed, April 2nd is going to be a very important day. We'll know a lot, but we also will not know a lot. It's a start. It's not the end of the resolution. It's not the end of the uncertainty resolution related to tariffs. We will know something, and some things on which we will know that it's going to be no negotiation. And just because something has happened on that day doesn't mean the issue has been put to rest.
We've been talking with analyst after analyst who says the uncertainty and the likelihood of increased tariffs has reduced their growth expectations for this year. We see that pretty much across the board. We talk to analysts who say they do expect an equity downgrading with respect to expectations going forward. Why have we seen such calm in credit markets that don't seem to be pricing in the likelihood of any material slowdown?
So a few things have happened. I think there are. First is if you've seen a lot of damage in the equity markets, much of it has come from the technology stocks, right? With the Mag 7. So if you look at the composition of the credit markets, credit indices, and compare that to the composition of the technology in credit indices versus equity indices, credit has much less technology. That's one thing. The second, I think, important thing is that there is the emergence of private credit definitely had a play in. There's an effect of there's a lot of money that's raised or dry powder that still needs to be deployed. There is a bit of that, and probably one thing that a lot of people don't appreciate is that the marginal buyer in credit in the last few years has been the insurance buyer, the life insurance buyer. This is very sticky money. So this sticky money, when you have a drawdown, in equity markets, in the past episodes, there will be a drawdown in credit markets because of redemptions. With sticky money, that is very unlikely.
Just want to ask what a lot of people have been saying, which is this idea that the reason why you can get bullish on stocks is that you haven't seen any disruption in credit that usually is a leading indicator for equity markets. Has the credit world lost its ability, the public credit world, to be a forward-looking indicator of risk for equals?
I'm not an equity strategist, but I would say I don't think it is a matter of signals from credit markets being different. I think we have to understand that the people that have bought credit, especially in the last 2 years, bought it because of level of yields. So there is a certain yield-based buyer bid. If level of yields drop meaningfully, let's say 10-year Treasury drops to below 350, that incremental yield buyer bid would be much softer. So that is what is actually keeping credit spreads relatively resilient. Doesn't mean that if the weakness in soft data turns to weakness in hard data, it will remain resilient. But I would expect that credit spreads to widen if hard data begins to crack. But we have not seen that yet. But my only point I'm trying to make is even if hard data do. I want to be looking at John. Hard data do deteriorate. it's probably less likely that credit will widen as much as it would have in the past because of this yield buyer bid.
When we look at the soft data, I just want to go back to policy for a moment. You said that this uncertainty is going to live with us for the next 4 years. Morgan Stanley, for the first time in years, decided to downgrade their growth. When you look at tariffs, do you think it's more of a hit on inflation or to the growth side?
We think it's the effect on inflation. It's probably one time, and maybe in this year it might be a bit sticky. But the effect on growth is actually longer lasting, and I think more consequential is the effect of growth. So, it's the stickiness has to do with how if the tariffs are going to be evolving. But it's really each tariff is a one-time hit to a price level. It's a price shock. But the effect on growth is probably much more long-lasting and significantly more consequential.
This is the theory, and it all works intuitively in my mind and everyone who's listening to this. In practice, it's going to be harder to look through this. And that's the point that your colleague Mike Gapin of Morgan Stanley is making, that for the Federal Reserve to actually look through this in practice and cut interest rates with above target inflation and maybe inflation that's creeping higher, it's going to be very difficult to actually do. Austin Goolsbee, the Chicago Fed president, is speaking to the American press this morning and making the point that we need to be careful when you say transitory. And going on to say this about interest rates, it's not realistic to know the rate path right now. So as an investor, what degree of support are you expecting from the chairman of the Federal Reserve, the FOMC, if economic data does worsen? Because the thing that I keep hearing is that the Federal Reserve still has an asymmetric reaction function. It's pretty simple. They stay on hold. If things get worse, they cut. It's the second piece of it that I think we've got to keep asking questions about. How much pain would they be willing to tolerate when they have above target inflation?
I think I totally agree with my colleague Michael Gapin. I think the ability of the Fed to look through the inflationary, sticky, higher, firmer inflation, we think is limited. So our expectation is one cut in 2025. And as a bond person, looking at that, what that means to me is that as the weakness in hard data begins to manifest, the market will start to expect that there will be a lot more cuts needed in the year ahead. So market will begin to price in more cuts. So we think in that our expectation, Michael Gapin's expectation, is a lot more cuts to come in 2026, where inflation would be coming down, partly because growth will be much weaker.
So you have to backload them.
You have to backload them, which means duration. This is one of our major rationale for being long duration, is that if we are expecting more cuts to come ahead, and I'm not expecting much of fiscal expansion, much fiscal stimulus, we think that just really means it's a good time to be long duration, and I think it will be pretty rewarding. So, for example, our year-end expectation for 10-year Treasury, my colleague Matt Hornbach's, is 4%. 10-year Treasury. And if things, this tariff pressure builds up, we actually think that number can go below 4%.
Vishy, thoughtful stuff. Thanks for the conversation on cricket as well. A clinic as always. Vishy Tirupattur of Morgan Stanley, and a little sprinkle of Quidditch in there as well. I heard you mention Hogwarts.
All right, okay, all right. I actually wanted to comment on Goolsbee.
Oh, Bramwell from Gryffindor, please.
Oh, you put me in Gryffindor. That's very sweet of you. Okay, so Goolsbee talking about kind of the comment that you made, the longer you wait, stop laughing at me, that rate cuts will be backloaded. And that goes exactly to Vishy's point. He actually said that part out loud, which is what they're predicting. If you wait long enough, you're going to end up with greater weakness in the economy, and you're going to have to eventually cut that much more down the road.
As we get those comments, yields are lower by 3 basis points. The equity market near session lows. We're down about 0.7%. With an update on stories elsewhere, with your Bloomberg brief, here's Yahara Hacker. Say, Yahara.
Hi, John. President Trump is moving full steam ahead to his April 2nd tariff deadline. Trump posted moments ago on Truth Social, the day will mark Liberation Day in America, writing that it's time for the nation to get back money and respect. Meanwhile, JP Morgan is changing the E in DEI. According to Reuters, the bank is swapping out equity with opportunity and renaming its programs Diversity, Opportunity, and Inclusion. The company also plans to reduce training on diversity topics, according to the report, and move away from central management of the programs. And the Boston Celtics have been sold in the largest sports takeover in history. Private equity mogul Bill Chisholm led the group, including tech and real estate investors, that is buying the team for $6.1 billion. Chisholm outbid at least 2 other groups, including one led by Celtics minority partner Steve Pagliuca. And that's your Bloomberg Brief. John?
What a run Steve's had with that franchise. Unbelievable. Yahara, thank you. Have a good weekend. Up next on the programme, for those of you who want to know the latest over at London Heathrow, we'll touch base with Guy Johnson in just a moment. Stocks are rolling over here. Session lows were down by 0.75% on the S&P. On the Nasdaq, we're down by 0.9%. The opening bell, of course, is just around the corner. Neil Dutta of Renmac writes in, Trump on monetary policy is the best version of Trump. He should say what he means more.
Well, I think that he agrees with him and thinks that the Fed should lower rates. So there you go.
The equity market might think the same. We're down by 1 full percentage point on the Russell. I promised you an update from London Heathrow, so let's cross over to Guy Johnson for more. Guy, what's the latest?
The latest is the airport is still closed, John. All 5 terminals are closed. Nobody's coming in, nobody's going out. All flights have been cancelled at this point. The earlier flights that were inbound have been diverted. So it looks like we're probably in for a few days of chaos as a result of this. Thousands of passengers, aircraft crew, all out of position. That's the narrative that I think a lot of people are going to have to deal with. Clearly, there are concerns in the UK about how such a major piece of infrastructure could fail, how a single point of failure at a substation a couple of miles north of here could cause such chaos to such a big and important piece of infrastructure. That's the longer term conversation. But in the near term, John, passengers are stranded. Nobody is going anywhere. The airport is completely closed. Even if we were to see power restored over the next few hours, it is unlikely the airport will reopen until tonight. And then the long and tedious task of repositioning everything to get everything back up and running will begin. But we haven't even got to that point yet. So, yeah, not much of an update at the moment, not much information. It's kind of where we were, and it's where we are.
Guy, looking forward to your coverage throughout today. Guy Johnson on the ground at London Heathrow. From New York City, that does it for us. Equities near session lows. We're down by 0.7%. Equities are lower going into the weekend. On Monday, we'll pick things up with Keith Lerner of Truist, Sharon Miller of Bank of America. We'll speak to Dana Telsey and Troy Gajewski from New York City. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to another special Miami Open update for Bloomberg TV and radio from Tennis Channel. Coco Gauff raced into the third round with a perfect performance against fellow major champion Sofia Kenin. The 2023 US Open winner didn't drop a game in her opening victory, which took just 47 minutes. And don't forget, you can watch all the action live daily on Tennis Channel.